All right, you can, if you want to turn your cameras off, if you're worried about your face being seen, you can do that. I'll let you know when the camera's paused, the recording is paused, so you can come back on. But everyone's encouraged. Hi, Steve. You're muted now. Just want to make sure.
Am I doing any better?
Now it's better. All right.
All
good.
right.
All right, cool. Thank you. Good to see you.
Good to see you.
Let me close this shit. All right, and I'm still making my charts here. I'm a little burnt out. All right, so there's the daily. We'll be using that to go through day by day. And there's futures, and then I'm going to do options and futures right now, like in front of you guys. So you guys can just shoot the shit or talk for a second. I want to make sure I get this right. It's not perfect, but it'll have to do. All right. All right. So the market was down on the week, right? I mean, it was. I know it was. Just trying to figure out how much lower it really was. All right. So gamma. I'll start with the gamma because I'm doing it out loud while I'm seeing it. End users are long gamma. That makes sense. They got less long as the market dropped. Producers got less short as the whoa. Oh yeah, producers got a lot less short as the market dropped. Wow. Okay. Maybe someone traded some options. All right. Longs got a little bit longer, so they bought calls. A lot less short. I wonder, maybe this is the expiration coming into view of last week. Scott, are you here?
Hi, Vince.
Hi. This is a big change for gamma. You know what I mean? I wonder if this is the options being factored in late.
I don't know, but I'm just looking at it like you for the first time.
Okay, yeah.
But I mean, it would be consistent with the falling market, right? And
it would,
just
but no, it's consistent in terms of direction, but it's magnitude, right? Right. Oh, here it is. Here it is. Here it is. Here it is. Look at this. Calls. Here's our violator. Other reportable, where's my rectangle? Other reportable longs. They didn't have that much gamma. You follow me? They got shorter 6,000 lots on up. Maybe it's expiration. I don't know. Options were either sold or expired. These guys got.
well, there was a lot of open interest at the 3,400 strike.
That's right.
In calls, so that would be consistent with that, right?
Right. That would be. Right. So here you go. There's your matchup. This, by the way, is macro discretionary. And these guys were the other side of that trade. These guys and these guys. Yep. So that's 3,000, 3,300, 3,200, 3,300, and 2,900. So let's call it 6,500, 6,300. And this is about 6,000. So there you have it. So either, right? Either this is significant because it's the market dropped, just for people that are not familiar with this. The market dropped. Generally speaking, the macro discretionary longs The other reportable longs and the managed money longs are long options. When the market drops, they either buy more options, they rarely do, sell options, they frequently do, or they do nothing and their deltas of being long shrinks because they have positive gamma. Conversely, the shorts of those options are almost exclusively swap dealers, short players, and producers who tend to sell calls. So the call sellers are producers and producers, not end users, and market maker swap dealers, the traditional bullion banks, and the buyers are the speculators in the rectangle on the right. And as the market drops, the gamma makes the longs less long, and the gamma makes the shorts less short. But this is a big number. So either a lot of options traded or there was a big expiration. And we know there was a big expiration. So this is, I'd have to say, the cleanup of the legacy open interest from the rally. Everyone's got their bullets back. And what we've seen over the last, oh boy, almost year and a half now is that the banks have been increasingly reticent to make markets and options. And at one point, didn't make markets and options at all. And the futures ended up not being something they made markets in as well. We believe collectively, I think, that the banks had been handcuffed by their risk managers to stop trading options. And they got run over by China in between March and November of 24. I believe they've been handcuffed. And I think after the banks covered their shorts in the futures in that big rally we had in the run up to what did he call it? Independence Day or Liberation Day. In the run up to the tariff deadline, the banks had covered their shorts because of the tariff risk, because of the gold repatriation, because of all these other reasons. And at the same time, macro discretionary was selling. So open interest was going down as the market was going up. And that was the market losing activity. During that time, open interest in China went up as the market went up. So the speculators are kind of geographically relocating. The options are the legacy position. You don't get out of those right away. They have to expire. So this is a legacy position from the 2024 through the first half of 2025 coming off. Why is it significant? Because it's another reason to not trade the COMEX. Now, I'm not trying to tell you the COMEX is completely dead. I'm just saying that if this is true, if what I'm saying is true, and it probably is, at least largely, now the banks have really cleaned up balance sheets and their portfolios are cleaned up. And now we'll see them have either get their balls back and push the market around a little bit, or continue to remain reticent to trade at all. I believe if they remain reticent, it's because they know that the whales are out there buying the dip in gold. I believe if they don't remain reticent and start pushing it around, which I think they started pushing it around last week, and the report from Goldman Sachs makes me think they're bearish now. If they don't see the buying underneath, based on how the banks act from here on in, will tell us if the buying is underneath. They know it's out there. If it's out there, they understand who the buyer is now. The buyers are now, and if they start selling it or not buying the dip like they were before, then we might be back to revisiting a redux. What is it? A slight return of the old school gold, which is not horrible, but we're just not going to have the trend that we had for a year. Okay. Let me save that.
Vince,
yeah.
Can I ask a question? And sorry if you've covered this in your Goldman's report.
Yeah.
But do you remember this? Do you remember the maturities of it was a 3,300 and 3,500? 3,500 was in December. And I think the 3,300s, were they in June or July? And if so, do you know the date? Was it like
Yeah. I don't know the exact date. Actually, I have the exact date somewhere. But that's a fair question because implicitly you're tying it to what just happened. Goldman Sachs put out two recommended exotic options to its clients. And this is when they were long and bullish and were trying to put their good clients into it. And the structures were simple. One strike. This is where I think the market's going to go by. Oh, I remember now. July 31st. So by July 31st, people were buying options from Goldman, and they weren't getting short. They had to hedge this risk, which is, I think, where we're going with this, right, Scott? Clients, institutional clients, were buying two options from Goldman. They had a bunch of them, but the two that mattered the most were a July 31st expiration of spot trading. What was it, 3,300? Do you remember?
Actually, no. Now that I think of it, yeah, no, it's not. It's not that relevant, is it? Because it was at spot had to fix, didn't it, above 3,300, which is done.
Yeah, yeah. Which
So
is done, right?
whatever that option was, is now in the money, right?
Right,
Yeah.
right.
So
No,
their clients along 3,300 calls, right? Oh no,
well,
it was
that's
a
the thing.
digital. Sorry, it was a
option,
digital. Yeah.
that options that okay, well that's you don't have to go that far with your calculus. Okay, these options are what's called one-touch knock-ins. So the market was trading, let's say 2,500, and Goldman said if the market trades 3,300 and the fix the PM fix settles above 3,300, then you're paid. So they basically said, we'll pay you 10 to 1. So it doesn't have a delta. It doesn't like trade up and down. It just, you're paid. And so that option fit very nicely with Goldman's existing portfolio, which was being long options in general. So the 3,300 option touched is no longer relevant. The 33 and 3,400 strikes just expired. And now the only option that matters is a 3,500, which expires in December 31st. Okay? So we have time for that one. But you'll notice that the gold market fixed right below 3,500. It didn't get up there. It didn't touch it. So the 3,300 options expired in the money because Goldman had their own options against it. But the 3,500 options did not. So anyway. But that's a good point. It's not a coincidence that the options that were expiring July 31st that their clients had have a window, are no longer relevant as the options that just expired went off. Meaning, if the banks still had risk, they would have rolled their options that expired just now into the next month. Now maybe they have, but I don't think they have. So anyway, I don't want to make too much more out of that than it is, but the bottom line is this. Goldman's clients' options expired. Goldman's options expired. And that was Goldman's clients' options probably too. The long. Goldman's options expired. That's here probably. It just everything's just collapsing. I'm not, everything's collapsing in open interest. We're really ending a cycle now. I'm reading Iggy's statement. Okay, I'm going to leave that open. I'm going to answer that, but I want to get through. Let me get through this first, and then I'll do the questions. Right. So, actually, I'm going to close the questions because I'll start fucking talking about them. All right. So here we go. Here's hold on. I need this link. All right, here we go. Here's the 5 days, right? We started here. Actually, it's 4 days. No, it's 4 days of trading on Randy's chart here. And it's 5 days because I'm using spot. So June 19th, Juneteenth was a day that we were shut down, and probably why we didn't get a report last week. Right, Randy?
That's correct.
So think about it. That was a Thursday, right?
Yes.
So because the government was closed Thursday, they decided to take Friday off too. I mean, can you imagine? Like, so we didn't get a report for the whole week. Excuse me. All right, here we go. So we've got a down day. We ignore this day here with a little purple arrow that I put. Unchanged. Again, people were probably off on that day too. A day that starts higher and goes down, and then a down day. But none of these are trend days lower, right? So what do we got? On day one, the market's lower. Open interest goes up by 1,000 lots. Shorts getting in. Not a lot. On this day, market's unchanged. Open interest closes, but it starts out lower. So maybe some longs got out and then some shorts covered. So again, really light volume, nothing to get crazy about here. This day, market opens higher, closes lower, flat open interest. So it would be longs getting in and just getting done, right? This day, 5,900 out, longs getting out. That's it, right? So overall, I'd say these first 4 days, or 3, depending on how you look at it, these first 4 days are essentially noise, and this is the day that matters. Now we go, these 3 days, however, are significant. And although everything that I've written in the last 6 hours is like, oh shit, I'm worried about the downside, I'm looking at this for the first time. This day on Friday is a reason to not be so bearish. Now, hear me out. All right, so we've got a little update here. Open interest comes in by 820 contracts. Market has a little tiny short covering rally. So I would call it this way. Let me get the drawing thing up there again. There we go. That's a shitty color. That's better. All right, so here we go. Down day, open interest comes in. That's longs puking. All right. Up day, open interest comes in. That's some shorts covering, probably shorts that were some little shorts that got short in here. And then this day, another noisy day, opens higher, goes lower. You could see, by the way, when you hear me say opens higher, goes lower, you start, if you're a technician, you start to look for bear flags. Down, opens higher, goes lower. Opens higher, goes lower. It's how bear flag works, right? And this day, somebody just gets bearish outright. Open interest goes up by 5,400 contracts. There aren't many longs left in the market that we see. Okay, if this were at the end of a down move, we'd all be bullish now. We'd be looking for a fish hook. But this is possibly at the beginning of a down move. We'll put it this way. It may not be at the beginning, but it's certainly not at the end. And what I'd like to see is, like, there are 3 things that can happen from this day, because this is an important day. One, there's always 3 things that can happen. There's a million things that can happen. But you have a down day with new shorts getting in. It's either deep-pocketed money, which you usually assume is smart, or CTAs, which you usually assume is not. Because of the size of the selling, because of the move, I tend to think this is some smart money. Okay? And I think it because this is the day that the Goldman bearish report came out. And it's tactically bearish. So I think Goldman's clients, not just Goldman, I can say Goldman all the time. I mean all banks. Just Goldman is the one that we see the most of. The banks are getting ready to run the stops. That's my opinion. So the banks are back in business in here. The banks put out a tactical sell recommendation. Mind you, they never put out a fundamental sell. Goldman never, you can't expect Goldman to say we're going to 4,000 and then 2 weeks later say we changed our mind. They have to say we're structurally bullish but temporarily bearish. And while they're temporarily bearish, they and they're selling this. That report I sent out this morning, that was institutional insight. That wasn't retail. All right. And even then it was couched very carefully. So here we are here with 5,000 contracts in. And I would say to you, without doing any more analysis, I'd say one of three things can happen. One, we gap open lower and just keep going lower. That's old gold. That's before 2024 gold. Two, we have a short covering rally and we see how much higher it takes. We either get a bear flag out of it or we gap above this and the market runs, which is no help to you. Or three, we have a sell-off as more shorts get in, but it doesn't go much further. So it's kind of like what you do as a tactical trader depends on what the market does. So I'll give you the three scenarios that I would do as a trader. If the market comes in weak, I would get short, okay? And I would stop myself out, let's say it unchanged, okay? If the market comes in weak and I don't do anything, I could just wait and do nothing. And I wait to see if it comes in. Let's say the market gaps in lower, okay? Gaps in 20 lower. And then it leaves a long wick at the end of the day. Then I would say shorts. Somebody sold it in the hole, and now we could have a possible rally. Will that rally become a bear flag? So it's kind of like this. Here's the day. The next day we open here. I'm exaggerating. We get the idea. We open here and then trade up to here. So it's kind of like here's your body. Here's your wick. And there's your body. So you get a hammer, right? And then you have a possible fish hook because the open interest on this goofy candle I just drew would probably go up a little bit. And then the next day you have your short covering rally. Does it get above here? I don't know. So if the market were to come in lower, I would do, me personally, speaking personally, if the market were to come in if the market comes in below this bottom, below this low, looks like 30, no, it's not it. If the market comes in below this low, I can't do anything. Personally, I would be a buyer if the market went back up and broke unchanged. If the market went back up and broke unchanged, or just the market went back up a little bit, let's say the market comes in lower and then does this during the day. If I wanted to be bearish, I'd sell it and stop myself out at unchanged. Okay. The other scenario, the fish hook scenario, which we've had a lot of for the last year because of the dominance of the buying underneath, has been this scenario. The market comes in here, goes lower. Maybe you have a long wick, maybe you don't. But it finishes here. The open interest goes up, but you have either a small green candle after a down day, or you have a small red candle with a long wick. And then we'd have the buy level, the buy indicator. So as it stands right now, if I were trading the open, I'm long silver. I have nothing on in gold. If I were to trade this on the open tonight, and I would be tempted to do this, if I were actively day trading, if the market came in between here and here, between the close and the low, I would do nothing. If the market came in below the low, I would do nothing. If the market came in below the low and went back up into this dead area, I would sell it. The market got above unchanged, I'd cover my short and buy it and expect this behavior. All right. Otherwise, we're either going to get this behavior, right? We're going to get this behavior, which I don't want to be a part of this because if it goes down and if it doesn't come back to unchanged, I don't know what to do. So I'll just wait. Or we get this behavior. The market comes in and finishes here. And then the next day we go higher. So it's an important day because it's a large number of contracts that got short and they are in the money already. So I want you to think of it this way. 5,500 contracts come in and get short and their average short price is here. Right? So for argument's sake, I wouldn't be bullish. I wouldn't think about being bullish for another leg higher until we got above here, which is this wick, the bottom of that wick. Otherwise, I'd be bullish from here to here, but I wouldn't take it home. I'd be bearish under here, and I'd be bullish for a long wick below that finishes unchanged. All right, that's this chart. That's right. That's the right assessment. It doesn't necessarily mean you're going to make money, but it's the right assessment. Yeah, let me look at the Bollinger Bands. That's right. Let me power through this, and I'll get to the Bollinger Bands. I tend to make more of things that need to be made of. All right, so that's done. Here's the futures. The market's lower, right? All right. We start with this. Of course, I changed the color. Now I need a different color. All right. All right, so here we go. The market drops, long funds puke, short banks cover. That's what they're supposed to do. Long funds puke, producers cover, which is what they're supposed to do. And short funds add, right? See this money here? Like that's not the last day. This is in the report. This money here is the money that I think covers. And if more of these guys sold on Friday, then we're golden for a rally next week. I don't think they did though. Or at least they didn't do it alone. So these guys sold. So here what you have market makers cover, funds puke. That's consistent. You have new funds get in short and producers cover. This relationship right here is not bearish. That's not bearish. And these guys get long, that's also not bearish. I mean, there's bullish, not bearish, and bearish. So when I say not bearish, I mean neutral. All right? So there's the whole day. The options, which I think we covered. How do I get out of this picture? Oh, there it is, over here. The options, which you covered. There's the options again. All right. I want to go to charts, but I want to look at Randy's open interest first. So there's his open interest. Let me make it bigger. And yeah, that sucks, you know? The market's still hung over. If I want to be bullish, I'm going to say the market's still hung over. If I want to be bearish, I'm going to say this, and I mean it. Stay short as long as open interest doesn't get above that. If open interest gets above that, then you have fresh money coming back. That's it. I don't mean to be a downer. I'm going to lose money if I'm right. All right. I'm going to look at the questions now. Randy, if you want to say anything about that or draw my attention to any charts.
Yeah, thank you. Just one. Despite Armageddon, who's got the nukes and everything else, we haven't had a greater than 10,000 up or down day since May 30th.
Yeah, there's no
okay.
That's right.
The psychology of gold has changed. I don't know what it is. Arena, help us out here, but the psychology has changed. Nobody panicked up or down, and take that for what it's worth. That's the biggest thing I see.
Right. I mean, right. So if you were to tie in several trends, one is if you were to tie in, what you'll find out is that when you're in tune with the market, the news, the intuition, and the price action all say the same thing. So, for example, the news, tariff, what am I calling it? The ceasefire on tariffs and the literal ceasefire on the war have dampened the rally. Now, we've seen these before and the rally not get dampened, but here we are, it's dampened. And we all of us here know that the ceasefire could be complete bullshit. It could change tomorrow. But really, let's look at the Trump-China one, the trade war ceasefire. We know very well, given the volatile nature of Trump's negotiating style, and the closed mouth behavior of China, that this could blow up overnight. That's what a black swan is. But the market doesn't think there's going to be a problem. So this is why you would be buying 5 delta calls, not 25 delta calls. You don't want to spend a lot of money on it. Specifically, what I'm saying is, despite the same mathematical risk of the trade ceasefire exploding, gold doesn't care. Now, why doesn't gold care? I don't know. Can the market be wrong? Sure, it can be wrong. You'd be truly contrarian right now. This is actual contrarianism. Everybody thinks the tariff war is over. Everybody thinks the Iran-Israel war is on the process of being closed. Everybody thinks the fiscal situation is going to be okay. I tend to think, as a contrarian, that one of those 3 things is going to go belly up. And that's a black swan. That's not even a black swan. That's a contrarian opinion. That's a true contrarian opinion. Now, the reason that contrarian opinion, I don't hold it, the reason I don't hold that contrarian opinion right now is because there are no shorts in the market to make it get started. There's no people to stop out. Who were the shorts for 2 years? The bullion banks and the funds. And in the end, it was just the bullion banks. And now they're not short and they're participating. So there is no vulnerable short in the market right now, at least not a big one. So even if my contrarian opinion happens, the market, based on that information, rally should be muted. Now, you may say, well, if there's no longs in the market, then they have a lot of room to get in. I agree with you. But the evidence that I'm seeing is that the longs are no longer in the U.S. If they're going to play, they're going to play somewhere else. And that goes to COMEX being somewhat broken, which also goes to the banks and the funds being told to close out months ago and the market getting kind of rigged. The market was rigged 4 months ago, guys. It was rigged. And we're dealing with that now.
Vince,
yeah.
sorry to interrupt. How often do you see this pattern of rising open interest and falling prices?
I'll give you 3 instances. You ready? Before 2023, let's call 2023 December. That's for me a big time, right? So let's use Russia, okay? February 2022. Let's use that because 2022 to 2023 was a gray area. Before Russia, and then after Russia, all right? Before Russia, the normal behavior was open interest going up in a down move would definitely happen at 2 points, if at all. Not a lot, but it would happen. It would happen on the highs. And it did not happen on the highs a lot because on the highs, longs were getting out. So let's pretend there's 2 funds in the market. There's a big bullish long who's long, and there's a big bearish short who's flat, waiting for a level to pick to sell. You follow me so far? So you've got a long.
Yeah, thank you.
Right, you've got a long macro. Here's the point of it's hard to see after the rally. It's easier to see on the sell-off. So the market rallies, and you got the big macro discretionary long who's just counting his money, and he picks a level to get out. Whatever his level is, who cares? But that level also is a moment where the dummy CTAs are coming in buying, right? So you've got CTAs, momentum buying, and macro discretionary selling. At the same time, this is a fact, at the same time, that other big fund, that's a bearish fund who hasn't sold it yet, he starts selling. And so at the top, you have open interest. You have longs selling to longs, to old longs selling to new longs, and the open interest goes nowhere, right? And then you have new shorts also selling to new longs, and the open interest goes up. And you say, open interest is going up on the highs. I think we're okay. But you're wrong because the next day, we drop a little bit. you have like basically the inverted fishhook. We drop a little bit and open interest goes up. And you say, why is open interest going up if we're dropping and the funds are buying and the funds are selling? That's because the buying of the funds ran out and all that's left is the fucking bear going like this. I want to sell more. I want to sell more. So at the end of a rally, when that happens, be very, now it could be jet fuel for the next leg higher, but before 22, it was the top, always the top. It was the inverted fishhook. You didn't see it all the time, but you saw it. The other time, again, before 22, you would see the market make lows. So market's dropping, open interest in, funds are puking, funds are puking, funds are puking. And then the market hits a point where it'll either open interest will go up and the market will go flat, or the open interest will go up and the market will go down and then finish green, like with a long wick. And that's the beginning of the fishhook. So there's two types of sellers, just like the two types of buyers, right? One type is the smart money that fades the rally, and the other type is the momentum type that goes with the weakness. Same thing on the bull side. So when the open interest were to go up on a small down day, that's on the highs, that's your reverse fishhook. And when the open interest goes up on a small up day after a huge drop, that's your fishhook. And that's where the open interest will go up. So invertedly, that's how you look at it. Does that explain it?
Yeah, no, thanks, Vince.
So now that's pre-2022. Post-2022, we didn't see any of these. Or put it this way, we'd see them and we'd all look at this and say, oh, somebody sold this. They think it's the top. And in the beginning, it was like, that could be the top. I'm worried about the fishhook. After a while, it's like, it was never the top. It was like someone sold it, rocket fuel. Someone sold it, rocket fuel. It would just do this all the way up. And on the way down, we never got these on the bottom anymore. No one sold it on the way down anymore. You just had banks going like this, buy the dip, buy the dip. There was constantly people buying the dip. There was no one selling the dip except funds that were long getting out. So that was during the big bull run we had. Now we are, you know how people like to say there's I wrote this in the story, but I pulled it out because it sounded obnoxious, but I'll be obnoxious here. Everyone, not everyone, but there are guys out there who have learned what the word inflection means. And they'll say, we're at an inflection point, to get you to fucking look at their story. We're at an inflection point. This is important. It's a dog whistle for traders. And the inflection points, of course there's inflection points, but this is a behavioral inflection point. We had before 22 when we knew how people would behave. We had after 22 where I slowly figured it out. By the time 23 came, I'm like, oh shit, this is becoming, you know, I still was always throwing water on my own bullishness, but I was calling it properly, at least reasonably properly. Now I'm saying I'm either ahead of the curve. Look, I'm really either ahead of the curve or I'm fucking wrong. Okay. This is an inflection point behaviorally. The macro funds have closed their positions. The banks paired up with them. And now we're in a market that's dropping and open interest is going up. Is this the beginning? I mean, the end of a rally? You know what I mean? And we're having a reverse fishhook? Or is this the end of a sell-off? And based on the volume, based on the volume of shorts and the fact that I believe we are, again, I am believing we are at a behavioral inflection point because the COMEX and the LBMA broke the fucking market. Like, this is a big deal for me to say this. Like, I'm saying that the market is broken and it takes time to heal. I've seen it. I've been in markets that were broken and watched them like, Jesus, the market really sucks. You know, there's no follow through. It gets pushed around. I'm losing money. You know, my style of trading stops working, but I've learned since then. And so now with that wisdom, for lack of a better word, and this information, I'm saying the inflection, for me, we are not at a price inflection point. But I am at an assessment of the player inflection point. And so I'm going to finish up. I'm going to again. I'm sorry. Good.
No, it's quite interesting. So you know, reconciling this to your long-term thesis, you know, there is an idea that the bullion banks are trying to get their shorts back for whatever reason.
Right.
And before they had to advertise higher prices to be able to get them back.
Yeah. Well
And
put.
now, because no one's buying, they've got to advertise lower prices to generate fresh open interest to get their shorts back, right?
That's interesting the way you put that. Just everyone listen to this. In the rally, um, they had to advertise higher prices, which means literally put out reports on it. But at the same time, they had to buy it and make sellers attract sellers by rallying the price because they were short and they needed to buy. They didn't want it to go up. They just had to buy. Now, no longs are playing. That's a good point. No longs are playing, at least not the big ones. And so if there's no one in the market, how are they going to get it lower so they can buy more dips? They have to, quote, advertise lower prices. They have to be bearish. It's kind of like, this is funny, Scott, that you're saying it that way. When a bank was long in gold before 22, in order to get it to go up, they told people to buy it. And that was when we were bag holders. We'd all come in and buy it, and they'd be like, sold, 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 right? Now, you could be seeing a market that's completely reinvented itself, and the banks are like, we need to buy it. Well, then tell them to sell it. Sold, 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 then they buy it. So the behavior of the banks is always the same. It's a matter of if they're weak or strong. So to add some weight to what Scott's saying, if you're bullish long term, as I am, mind you, we're 3 years into the long term. It's not like it started yesterday. But if you're bullish, I'm still much more bullish long term. But we just had like a nice run. If you're bullish long term and you've broken the market, you have to create interest. And when I say the word interest, you think open interest. So the banks that want to buy need someone to sell it to them. There's no one left long. So why not advertise it lower? So they could be, we used to use the phrase, sell it to buy it, which means tell your clients to sell it so you can buy it from them. I don't know, but yeah, that's right. The market is showing signs of being complete. If the long-term trend is intact, what Scott is saying is the banks still need to cover and they want someone to sell it to them. And so now they're making people sell it on the short side. If the long-term thesis is correct, that's what's happening right now. If the long-term thesis is not correct, it's not incorrect. But let's assume that it's 100% not correct, then this market is back to the old days and the market's dropping. And it's dropping because they're going to have their way with it and they're bullying it. There's no longs in it, so they're going to keep selling it until they get someone else to sell it to them $100 lower. I truly believe that. Now, if you listen to the two scenarios, one is if the long-term thesis is intact, the other is if it's not. Here's what I think the answer is to Scott's implication. The long-term thesis is intact. All the big money is out on the long side. The CTAs are still fucking profitable, guys. They've been buying on average since March, and they're still profitable. And they're not all stopped out yet. Now, there may not be a lot of them, but they will act. And what's the rule? If the big funds aren't playing, then the CTA footprint grows and they determine price because it's like, a kid in a candy shop for the banks. Oh, look, I have a kid and he wants to buy this candy. I'll raise the price as he walks in the store. So the CTAs are wildebeest. They herd. So synthesizing the two, right? The long-term thesis is still intact as far as I can see, but we do have one big profitable cohort who's no longer being protected by the macro discretionary buying the dip. And I think that cohort is going to get stopped out. The interesting thing is that cohort may get stopped out. That last long cohort CTAs may get stopped out by macro discretionary selling it short. And so then now 3 months from now, we'll be talking like this if I'm right. The banks are buying from the macro discretionary and we're rooting for the banks. That's what's going to happen. I don't know what's going to happen, but that's it. Does everybody kind of get an idea on that? What I'm saying? Or am I just babbling? Okay. I'll take that as you're thoroughly bored or confused. All right, so here we go. Thanks, Braden. So Scott, did I address what you were saying? Like your metaphor or your scenario?
Yeah, and it just ties in with what you're saying that this could be an inflection point. But it's but yeah.
It's for me, it's a behavioral inflection point. But this is what I truly see, and I'm not speaking inflexively, if that's a word. Right now, I'm very confident of this. Right now, someone has the CTAs in their sights, and they're going to try to stop them out. And it's going to happen next week. So I am telling you that 5,000 shorts that got out on Friday is not the end. It's the beginning. Could they get stopped out? Yes. But will they try it again? Yes. Because there are too many CTAs making too much money, and they're fat, and they're sloppy, and they're lazy. And if with no one else is selling, if no one else is buying and they're long, then the market trades to the most pain. So the most pain is CTAs are the last profitable players in the house. They get stopped out. And then CTAs start to short it, or maybe macro discretionary gets shorted, and then the banks start to buy it. And then China says, "Oh, we'll buy that dip," and then we're off to the next leg higher. So speaking about the here and now, I firmly believe, and I'm 95%, not 99, 95% confident that they're in my sights. Let's put it that way. The CTAs are the last long in the market who we can get to puke. And we're going to do that if it destroys the market, because we just want to get our shorts back. We want to make some money too, and we're going to do it. There's no one in our way. I'm a bank and I'm short. China's buying, but they're below now. Remember, China, the banks were buying above China before, according to my story. Now, I don't see the banks buying. We're below the 50-day moving average.
Actually, Vince, that's a really good explanation, because discretionary macro, by its nature, is discretionary, right? So you need to entice them to sell, whereas CTAs are systematic and momentum. So the only way to get them to sell is to break them, right?
That's right. That's well put. So I'm going to give that. I'll give that a storyline. Here we go. I'm a bullion bank and I'm short. I have two clients. I have a macro discretionary fund that's made money being long, and they're flat. They shorted it that first time down. They got stopped. They're like, okay, fine. I'm not going to do anything. And I've got all these fucking little CTAs that are long, but they don't listen to my advice. They just buy because they have a system. Buy. And they're long since 31.50. That's the price. They're long at an average price of like 31.80. Okay, so call it 32, right? So they're long at an average price of 32. They're giving profits back, but they're long. But I can't get these guys to sell because they don't sell on an opinion. They don't have discretion. They're systematic. They don't say, I like it, I'm buying it. They have a system. They have an algorithm. So what do I do? I'm telling you, this is how it works. The bank goes, well, I'm not really allowed to get short anymore. I can only buy it when it drops and sell it when it rallies. I'm not allowed to speculate because I got my ass handed to me last year carrying too many shorts. So I'm kind of on a leash. But I'm bearish. So what do? You call up your macro discretionary guys, say, hey guys, listen. And you're honest with them. You say, I'm not allowed to short it right now because I got my ass handed to me last year. But I got a bunch of longs over here that I got to tell you, they're fucking easy to knock out. And you may think I'm making this up. I'm not. I cannot tell you how many times, well, I can tell you, where a broker would call me OTC and say to me, I got a market at 6 bid at 7. I go, what are you showing? Meaning how much size? And he'll say, I'm showing 500 up. But the guy's really a seller. And he knows I won't sell. I don't do 500. I'll do 200. Right? He goes, 500 up. I go, who made the market? He won't tell me who because he's professional, but he's semi-professional. He'll say, well, it's a bank that really needs to sell. That's why banks don't make markets unless they have to do something. They don't proactively go out there. So I'm like, so what are you telling me? He goes, well, if you hit his bid, it'll collapse. And I have more selling to do. I have a stop order. So I'm like, okay, like I would be the tool. I'm like, all right. And I didn't care because it was an option. I understood value. I hedged it. It wasn't really a lot of loss, but I got such goodwill out of it. So I'm like, all right, how is he? He goes 6 minutes, 7, 500 up. And I'll say, sold 200. And he's like, you're done. And then the moment I say it's a call. The moment I say sell 200, the market starts to drop, which is not supposed to happen when that happens, when you sell to a bank. Anyway, the point is the broker was using me to get the weak hand to capitulate. The bank uses the macro fund to get the weak hand to capitulate. It's really no different than a stockbroker calling you up saying, listen, I put all my best clients into this. I'm letting you know about it now. What is it? Give your friends a taste, from Wall Street. The point is, when you run out of money, you tell your buddies to buy it. And that's what's happening here. Yeah, I think that's a good explanation. All right, so that's it. So all right, I'm gonna read these comments and questions in a second. But I want to before it scrolls off the screen, I want to see Randy had a comment about another chart. So I'm gonna do Bollinger Bands.
I think you're gonna.
There's other things I can do, Iggy, but it's it's a little bit cumbersome. I can make it perfect looking, but I'm doing the best I can. If I can't go full screen, Iggy, I can't go full screen because I'm not full screen. I have things on my screen on the left-hand side that I don't want you to see. Bullshit and noise. I'm showing you a part of my screen, so I have to move stuff around, trying to keep some things private. But yeah, I understand.
Ravioli recipes.
It's the ravioli. Here, I'll show you what I'll show you what I'm keeping private today. No, because sometimes I have stuff that's open. That's important, like secret ravioli recipes. Here we go. See, now you're all happy because I'm making the whole screen public, but there's shit on here I don't want you to see because it's noise. If I was interested in perfect production, I would try a little bit harder, and sometimes I do, but I spent 3 or 4 hours doing work today for this, preparing, putting posts out. So I didn't really have a chance to do that. But anyway, I'll leave it open for today. Also, I use Mozilla Firefox, Iggy, and there's an incompatibility. It's intentional. It didn't used to be like this. Like, look at my arrows, Iggy. See my arrows on the right? Look at how small that is. Didn't used to be that way. Google changed stuff. All right, so where are we? I have that. I have this. Now I got to open up the window again. All right. All right. So staying with Iggy's question or Iggy's comment. All right. Oh, the Bollinger Bands, right? So let's look at the Bollinger Bands. All right, I'm going to go through the questions now, and then we'll wrap it up. All right. So here we go. See, I can't move stuff around on my screen now because there's all these menus that get in the way. All right, so we're going to go with Bollinger Bands. I have to move this now. What the fuck? All right. We're going to hide this to keep it simple. All right, so gold. Daily. Uh-oh. Iggy, spot on. Hold on. Oh, shit. I missed this. Good catch. See this here? It's very subtle, but you want subtle. That's a sell signal. That's a sell signal that says you should be short on my system, okay? You should be short right now, like you sold the close on Friday. You should be short right now, and your stop out for the first day is a ridiculously far away level of 33.03. That's $30 fucking dollars, excuse my French, and that's too big for me to sell. I mean, it is. I mean, I'll do it with options, but I won't do it with futures. So here's how to play this. I'm thinking out loud because this is how I would do it. I might sell gold because I'm going to stay on with my silver. All right, so now I'm going to go to an hourly. No good. No good. You might want to use an oscillator for what I'm doing here. Same idea. Wow. So we're 1, 2. We're 4 bars into a 4-hour signal, which means the market is close to being oversold on a 4-hour basis. The way I look at things, maybe another 4 hours lower. So purely on my signal, $33.01, 33. What? No, I will use it. 32.93, 32.93. All right, so I'm going to tell you by the numbers, this is a sell signal, but by my risk tolerances, it's hard for me to do. So, for example, the rules say you're short. We sold it on Friday at 32.74, and our stop out is ridiculously for this system 33.05, and that's because it was a big move. And had I been trading this intraday, I would have seen that hit up on a 2-hour and sold it. And if the market closed and gave me a signal, I would have took it home. So it's kind of like an early entry. As it stands right now, here's the trade. Here's the trade. We got the signal. The sell signal's there. It's there. Okay. We are oversold in the short term. We may have missed the first leg lower. So I would say this. This is me adapting my signal to give me something that seems common sense. See, I lost my drawing tool when I do it that way too. When I go full screen, I lose my drawing tool. That's the other thing. I have to find it again. All right. Right. Is that it? Okay. If the market opens up in between here and here, I do nothing. That's what I want the market to do if I'm bearish. If the market opens up between here and here, I'll say it again, I do nothing. If the market opens up between here and here and cracks either side of this, a new low, or goes above unchanged, above the unchanged on the close of the previous day, I get long. So I get long above here and I get short below there. This is my dead zone for this signal. So the signal is a bear signal. There is no doubt about that. But it's oversold on the short term, which means it could still end up going down, but it could go up to here before it goes down, because this is a very strong signal that's just starting. So the market for the next 2 days could do this, not stop you out, but make you lose your mind and then collapse. So I prefer having tighter stops and having multiple bites at the apple. So I'm going to, instead of selling it here and stopping myself out here, because you can't take it home if your stop out is $30 away, unless you're buying like some fucking 2 delta put. Market comes in between here and here, I do nothing. As soon as the market makes a new low, after coming in between there on the open, I'm going to sell it and stop myself out here. Flip side, market comes in between here and here, cracks above here, I'm going to buy it and stop myself out here, and I may reverse. So that's if the market comes in this range. If the market comes in above here, I do nothing. And I have nothing to do until it gets below here. If the market comes in above here, does not touch my stop out level. So let's say the market comes in like this. It comes in unchanged, works its way higher. I'm doing nothing. Pretend synthetically in your mind, I'm short. I'm doing nothing. It doesn't go above here. What do you have? You have a traditional back test of my signal. It doesn't go up there. As soon as it cracks here, I'm short. That's what I'll do, right? Let's assume that the market comes in here. So we did it. If it comes in here, or comes in above here. Market comes in below here, let's say in this area, I missed it. It's too late. It's over. Right? The signal's good, and I missed it because I fucked up. That's good catch, Iggy. Thank you. All right. Let me read some of this. On the 4-hour chart, look back to the 14-hour, 14th, as there is a similarity. Let me see. I have to stop sharing. I have to stop annotating. Fuck. All right. I'm not going to be able to annotate anymore. All right. So if I go back to the 4-hour and I go to the, you talking about here? That's the 11th. Gold 4-hour? John, wasn't Jonathan, that was Iggy. On the 4-hour chart, look back at the 14th. You mean here? That's the 23rd. June 28th. Yeah, okay. Right. So the 28th. Yeah, there's an example. Right, exactly. So you see? This is an example of why I don't sell it after I miss the first day. You know? This here, I'll give you guys a clean example of what we're looking at here. See this day here? That day is not a sell signal. This day is a sell signal. You're short on this close. And you say to yourself, similarly, you're like, all right, I'm going to sell it on the close, which is, 33.32, with a stop out at, crazy as it sounds, your stop out is 33.50. So that's $18. Not $30, but still pretty big. You're like, all right, I probably would sell that had I been paying attention, right? So you get bar one, 4 hours, 8 hours, 12 hours, stopped out. So you'd be short here. You get this down day. You get this down day. Remember, you're risking, by the way, the rule, if you're trying to follow this, is you sold this close. That's day 0. Day 1, you're short. Your stop out is here. At the end of day 1, your stop out is here. At the end of day 2, your stop out is here. So what were you risking when you put the trade on? When you sold it here, you were selling it at 33.31, and you were going to buy it back at 33.51. So let's call it $20, right? So you're risking 20 to make 40. You risk 20 to make 40. The key is you're betting on coin flips, but you get paid twice as much on the winner than you do on the loser. That's how you manage this. So you sell it here, and you say, I'm risking 20 to make 40. Next day it closes. That's day 1. You're risking 20 to make 40, and now you are in the money by $14. Next day, 3,300. That's $30. So now you're at 1.5 to 1, but you're trailing your stop. Your stop was here, then it's there, now it's here. So now your stop is 33.35. Market's trading 33.01. It made a low of 22.94. Where was I? Here, right? You know what? You pretty much got $40. I'm not saying you bought the low. I'm not saying you have to buy the low. I'm saying when you say to yourself, I'm going to risk $20 from here to here, and the first day you're in the money, the second day you calculate what's $40 under 33.31. It's 33, 32, 32.91. And what's the low here? Like 32.94. 32.95. Okay. So you didn't get there. But the point is, on this close, I'm telling you, like as a risk manager, this is me being careful. We almost got my number. I'm going to go home. I'm going to take a quarter off. I'm not going to be a pig. I'm going to take a quarter off because I just want to be right and make money. The next day, what does it do? It makes a bottom. It doesn't make a new low. And the market goes back up here. And now we're in day 1, day 2, day 3. And now you either get out on this close or you get out on this open. That's it. So you would have made 3.5 to 1 on 25% of your trade and been stopped out on the rest of it. You would have made money. You would have made fucking money. Yeah, that's a good trade. 4 hours is very painful. You're like, so 4 hours, it almost always goes overnight. 1 hour, let's say you're trading only American hours, 1 hour, you can deal with it a lot better. But yeah, that's a good symbol. example. So if you take that concept that we just looked at and apply it to this this current situation, which is here, which is here. Wait, am I looking at the right thing? Let me just start over. Right. If you take this 4-hour situation that we just looked at. Oh, fuck. And you could say that this and this are very similar. And I would agree. If you want to look at it from a very simple math point of view, they bar 1, 2, 3, 4, 5. So you've got 1, 2, 3, 4. Yeah. So how about this? See all this advanced Bollinger Band stuff I gave you? You pull up a 4-hour chart and you say, fuck it. If it gets under here, I'm going to sell it. Right? Traditional technical analysis. Sell off, and either this is the bottom or it's a bear flag. And you figure out what it is by putting your stops in. And what you'll find out is that traditional technical analysis will give you good levels for risk reward once you get in, but the signal comes from Bollinger Bands. All right, next one. Jonathan, change in behavior, some amount of news recently recognized. Yeah, you know what? As second reserve asset, BIS recent acknowledgement, Tether is not resilient. Seems like a sell the news event from bullion banks that made money on the run up. Yeah, I mean, it's kind of weird. You know, we're so used to fading the news, but for the last year, we've got so much good news that proved to be real that we're trying to figure out if we should be fading this news right now. And I think part of me wants to fade it. Yeah, I agree. Brett, the BIS report seemed like a freaked out over Tether. Yeah, did you see that report? That was outrageous, Brett. It's like they were really, really panicking. Here, let me read this, and then I'll let Brett explain what he saw. The BIS report, they put out a report saying that Tether's dangerous. Seemed like a freak out over Tether. It's unleashing US dollars in tokenized digital form to billions of unbanked people via smartphone. That's not good for business. By the way, the BIS is a bank. That's all they are. They're a big, big bank. They're a bank of banks. I used to be a Tether hater. Yeah, me too. I was like, oh, it's the collateral is fucking bullshit, right? But I think it could soak up treasuries and provide stability to developing market users. Yes, right? Whether it's morally right or wrong, whether it's going to create a bubble or not, the U.S. government doesn't care. They just need to get someone to buy our treasuries. And if we can't get a treasury to buy our treasuries, a country to buy our treasuries, Tether becomes a country. Right? Who's going to buy our treasuries? Well, I'm not going to buy a treasury, but if you say to me I can buy a treasury and use that treasury on full leverage to buy Bitcoin, it's like buying Bitcoin with a 4% cushion. I might do that. So more treasuries get held. So yeah, but the BIS report, Britt, before I let you describe it, I didn't actually read the report because I want to hear your take on it. The BIS report, look, the BIS is predominantly European culturally, even though the Fed's a big part of it. And so Europe wants to do CBDCs, central bank digital currencies, and that's not going to happen in the US. Central bank digital currencies are controlled by the government. To my limited knowledge, central bank digital currencies are government controlled, centralization, and the US government knows it won't work. Anyone who says CBDC will not get elected. And so the CBDC role in the US would be Tether, or not Tether stablecoins, right? And stablecoins allow banks to create products like Amazon bucks that allows them to, put your money in the JP Morgan stablecoin and you can buy gold, you can buy Bitcoin. And what is a stablecoin? It's like a treasury tied asset. So it's fucking brilliant. It's like you're making debt a risk on asset. It's fucking crazy, which kind of explains why treasuries do what they do now. So please tell us more about the BIS report, Britt. Do you mind doing that?
Yeah, it was surprising, but I guess is BIS trying to put a lid on people leaking from the conventional banking currency system into Tether. That's their main. I mean, Tether is like 80% of the stablecoin market right now. And I used to think that Tether basically didn't have the collateral that they said they did. So I thought that it was going to collapse at some point because they weren't holding the treasuries that they claimed to be. But
Right.
I looked into it a bit more and listened to the CEO of Tether. And essentially what they're doing is it's creating a release valve for anyone who doesn't trust the value of their currency. And this is going to compete directly with the euro
Right.
CB. And so I think that's what BIS is wound up about. And it could result in just a massive flow of people from all different currencies into something like Tether. And that's
Right.
to avoid their perception of devaluation of their own home currency. And so BIS
Right.
obviously does not like that release valve.
Yeah. Right. Exactly. That's exactly it. Right. Exactly. So on your screen right now, I think you can see the URLs. On your screen right now are two stories. One is the BIS story, which actually gets into it, and then there's Reuters coverage of it. And so to reiterate what Britt said, thank you. I didn't mean to put you on the spot, but I appreciate your response. Centralizers, of which all governments are centralizers, but Europe is much more centralizing than the US, are scared about losing their jobs. It's job security. And one of the problems that they have is they're not like, let's pretend for the moment that the BIS knows that its job security in Europe is 100% secure. There will never be Tether. Guys, there will never be Tether. I'm assuming this. I'm the BIS. There will never be Tether. Stable coins will never be accepted. You know, I'm exaggerating to make a point. And by European regulators, because European regulators will protect the franchise because they are the uber centralizers. The US says, you know what? Central bank digital currencies won't work here, but we do need to accommodate all this new interest in crypto and Bitcoin. And there are real applications. You know, I'm a tea farmer in India. Nobody knows about me, but now you can buy a stable coin that allows you to invest in Indian tea farmers who otherwise can't get a fucking mortgage. Like, you know, it really does unlock the little guy. I'm sure the little guy gets screwed by this, but it does potentially decentralize the centralized power. So I'm the BIS and I go, all right, I'm not worried. So why shit on Tether? Here's why. Because ultimately, this is a very free market statement, but I mean it. Ultimately, the economics of every system wins. So ultimately, you're Europe, and you say, you build a wall around yourself. We're protecting the BIS. We're protecting the BIS from Tether because we're trying to keep our jobs. No different than any other, I hate bureaucracies. No different than any other bureaucratic institution on earth. It seeks to perpetuate its existence. It's a living thing. LBMA, BIS, European Eurocrats, whatever you want to call them. And what you do is you build a wall around it and you protect it. If you have the superior system, you win economically in competition with, let's say, a decentralized government. But here's what's going to happen. I'm telling you, this is going to happen. This is like years down the road, but Europe will draw its line in the sand and say no to Tether, no to stable coins, you know. But then they'll come back with a new product that's not called central bank digital currency. Why are they coming out saying this? Because they want to scare their own people into not investing outside the country. See, you have a semi-free market in Europe, and you let people invest overseas, but you don't want them to. So you have to stoke fear. And that's why the BIS is doing this. Because 3 years from now, if they really do build a protective mode up, what are they doing? They're building a protective mode around buggy whips while the US has the car. and everyone's going to buy a car. And the line from that movie, Other People's Money, I saw the play. I love the play. The line from the play or the movie that I liked the most was if you're not familiar, Other People's Money, Danny DeVito. It's a pretty good movie. It came after Wall Street, but basically it's about using other people's money to do buyouts. But there's a line Danny DeVito's character says where he says maybe it was a Wall Street line, but I heard it in Other People's Money. It's like, I'm sure the last buggy whip maker on earth was the best buggy whip maker because he survived all the problems and all the closures, and he had 100% of the market share. How's he doing? And that's the point. Europe's capital will flee Europe to go to something that gives them upside. Comes down to FOMO. So the US, I don't want to extol the virtues of the US here, but the US, one thing the US is very good at doing is we know how to make our competitor compete against us economically and win. So when you lay down the rule, no tether, BIS, no tether, Europe, no tether, we go, okay, do what you want. But ultimately, we know the economics of it wins. And the economics of it wins if it doesn't blow up, if the collateral is good, if it's proper. In this sense, the US actually does the right thing. We over-regulate it. All we're doing is we're protecting JP Morgan. We know that, right? The educated retail, which is what we are, we understand it's buyer beware and we survive, and everyone else in your family gets fucked, right? Because they don't listen. They don't listen. They think the government's a panacea. Oh, the regulators will protect me, and they buy it. We know that the regulators are really kind of like a candle in the darkness. They're not really going to protect you. They're going to protect JP Morgan. But meanwhile, at least we have the opportunity to buy or to short these tether-based products. So I think this is actually very significant. Thanks for bringing it up, Britt. Yeah, so the battle lines are being drawn. And, to echo Tom Luongo, this is it, man. The financial divorce with Europe is on. SOFR, not LIBOR. We took our metal back. The euro-dollar system is in jeopardy. Not because dollars are in jeopardy, but because, I'm paraphrasing Tom here, the Europeans, the whole euro-dollar banking system is a piggyback off of the dollar as a strong currency. Well, Tether, stable coins end up, again, I'm speaking out of my ass here, right? I'm just educated enough to be dangerous. These assets that we're creating siphon off the euro-dollar system. And that means the banks, think about it, the banks that exist purely to take dollar deposits and make dollar deposits for Europeans are basically, they're assholes. They just sit in the middle and they take, oh, Europeans, you want dollars? Oh, well, I'm an offshore bank and I can take dollars, and the euro-dollar system is born. They exist solely because they sit in between a regulatory arbitrage. And so Tether and stablecoins remove them as intermediaries. Good technology disintermediates incumbent players. And that's what we're doing here, right? That's what's happening here. Anyway, I love it. And the reason I'm talking about it so much, aside from the fact that Britt got me started on it, is because like to paraphrase, not to paraphrase, but to echo Britt, Tether 2 years ago. What are they putting? Fucking, they're putting grandma's humbles in as collateral. Like, what's collateral? There's fraudulent collateral in there. But as a trader, I said to myself, well, as long as people keep buying into it, I'm disciplined with my risk, I'll buy some Bitcoin. That's what I did. I know obviously more money goes into Tether and Bitcoin goes up. I see that. And I go, well, that's bullshit. Is someone using Tether to inflate Bitcoin? And then once Bitcoin got regulated by being put into a spot ETF, well, they're not getting away with that anymore because now the government's also selling it. Now they're using futures to keep a lid on it. So now I'm like, all right, Bitcoin's going to be gold 2.0. It's not going to go up. It's going to suck. So I stopped buying and I stopped being interested in it. Just I have what I have and I'm just leaving it alone there. But then, the stablecoin thing happens. And then I read something, and most of you may know more about this than me already. Okay. So I'm catching up. Someone said to me, I go, like, what is the stablecoin product? Like, what is it replacing? Because it's disintermediating something. And the answer I got from a banker was, oh, it's the money market fund. And I go, what do you mean now? By the way, he was speaking as a person who hated it. He's a banker broker. I'm like, well, what do you mean? He goes, well, what is a money market fund? Remember when they broke the money market funds for a very short period of time? People think a money market fund is a savings account, but most of us probably know that a money market fund is actually a fund, like a mutual fund, that takes your money and puts it into some Fed products, gives it some Fed overnight rates, and gives most of that to you. So your interest rate, you get to participate at, say, 80% of whatever they get. That's what a money market fund is. And a money market fund is as good as a buck. But remember they broke the buck like in 09 or 10? Anyway, and I will look at all the messages in a second. Let me just wrap this part up. So what this guy was saying to me bitterly, Britt, he was bitter, okay? I heard him talking to me like I was me being bitter. He went, oh, they're trying to get rid of money markets. I'm like, what do you mean they're trying to get rid of money? Because we make a lot of money off of money markets because people keep their assets with us. So all the smaller banks that have their money market funds, well, not even smaller, but banks in general, he goes, well, a stable coin is the new money market fund. It's like a money. In other words, when you buy a mutual fund, you have to take your money out of the money market and convert it into cash. And so it's a transaction. He goes, well, the stable coin is the money market that allows you to directly buy into it. You don't have to execute it. It destroys the reason for the bet. Anyway, that's it. I'm done. I'm done talking about it. But
Vince, there's some interesting. Oh, I learned about where's Tether housing its resources, and it's mostly in treasuries, but it's also they're the largest institutional holder of Bitcoin in the world, and they're holding gold. I think Kevin mentioned that Tether is holding gold.
Yeah, a lot of gold, right, Kevin?
And then there's also like physical assets, like they're buying physical businesses and land.
Right,
And,
right.
Pretty wild, but they've actually got kiosks in the middle of nowhere in Africa where like they've got like 80,000 of these. It's like a solar panel and a battery, and they charge people three Tether dollars per month for a subscription to charge their phones. So anyone, like they're reaching like 500 million people that way. Anyone with a cheap Samsung phone can turn their whatever currency into Tether, and they're worried about. I mean, they might be more sophisticated and buy gold, but really they're just worried about the devaluation of their local currency versus the US dollar. So that's
right. Everybody wants to have an escape route. You know what I mean? Like I totally get that. I'm sorry, were you done?
Yeah, it's just like it's really what Tether is doing is they're actually trying to become the largest Bitcoin miner in the world. And it's not because it's a moneymaker, it's because they want to have influence and stabilize Bitcoin because they have a lot invested in Bitcoin remaining as a stable crypto, not being volatile or being.
It's like they're vertically integrating. Yeah. Bitcoin is our biggest asset. We may as well start digging for Bitcoin too. Yeah. Your comment about stable coins being owners of Bitcoin. Yeah, that's the thing. That's the thing. Stablecoin is the vehicle. Again, I'm speaking out of my ass. Stablecoin is the vehicle that allows you to buy something else without incurring other transitions. So, like it's a bad analogy, but I'm going to try it anyway. If you get credit at Amazon, don't use American Express. You go into a store. What's one that we used to use? Circuit City, right? You go into Circuit City and they say, we'll give you store credit. Well, you're like, all right, I'll keep it as store credit because Circuit City had a lot of stuff that you could use it for, right? Or maybe you get it back on your credit card, whatever. Or you go to a store that's really small and they say, we'll give you store credit. It's like, what do you have here? You don't have anything. Like Radio Shack when it sucked. You're like, I'm not going to go to Radio Shack and use store credit. I go there like for batteries once every 8 months, But Circuit City, I'm going to buy a TV. I'm going to buy stuff. There's a lot of variety there. So the analogy is stable coins are a bank's credit, like banks, not credit, coupons or store credit. So if you put your money in the JP Morgan stablecoin, you're going to have access to putting it into everything. The point is, you don't need JP Morgan to have a stablecoin, right? But JP Morgan is giving you the razor to buy the blades, and they're going to make their money off of trading against you, not so much off of fees. And by the way, that's why gold and Bitcoin obviously are the easiest assets to do this with. It's stable. There's really nothing complex about it. Let's try that first. For example, that's why BRICS, all these stable coins are going to start with the simplest incontrovertible assets. This is Bitcoin. It can't be replicated so far. This is gold. It can't be replicated unless it's got tungsten in it. But it's simple. It's black and white. And so they're going to do that. Eventually, we get to my idea where the tea farmer in India who's got a farm that makes, by the way, I'm not making this shit up. Let's use China. You're a tea farmer. I'll use a tea farmer in China. You're a tea farmer in China. But due to China's, let's pretend China's not communist or not authoritarian. This is, by the way, this is a jewelry loop. Someone gave me years ago. So, all right, you're a tea farmer in China. You go to the bank for a loan to grow your tea farm. You cannot get it because the rules in China, they're going to change, but the rules in China go like this. In China, a bank will not give you a loan based on enterprise value or based on revenue or based on cash flow. You go to a bank and you say, in China, you say, I have a business that makes $2 million a year. What can I get for a loan? And you know what the bank says? Nothing. Then they say to you, do you own any land? Yes. Do you have a factory on the land? Yes. They will loan you money to grow your business based on the hard asset value of your property. So what happens? You have a business on land that's worth, let's say, $1. Simple. Let's make it not ridiculous. $100,000. It makes $1 million a year. You can't grow it because the government will not risk loaning money to enterprises. It'll only risk money to real estate. That's how China operates, by the way. Okay? That's why one of the reasons gold is so important, because China only leases businesses money based on their real estate, not based on their business, or it's harder to get one anyway. And so if you own gold, it's like real estate. China is very real. And because of that, it hinders the growth of their business if they were to compete with us. Because you can't compete, right? We loan too much money, right? So now you got this Chinese tea farmer who's got a business that's, $2 million in profits a year on $100,000. The land is cheap because the government fucking does something to it, $100,000 a year. And now you got JP Morgan coming in. Again, assume that China will let them do this. JP Morgan comes in and says, hey, we're not going to give you a mortgage. We're not going to loan you against your business. But we've got all these investors who invested in a stable coin, and we're going to start a fund. And that fund is going to be investing in your tea farm. And we'll give you $1 million. And that's how it starts. And then they get in the middle of that and they do that. And that's pretty fucking cool. So you actually do unlock enterprise value in countries that do not allow you to monetize enterprise value. Anyway, I'm going off here. Let me read some of these questions here. Some of the for stay short, right? Oh, okay. So Iggy, the Bollinger Band indicator. Yeah, we talked about it before. Let me see if I can find it. That's it's called BB Squeeze, which I think, according to Randy, is the actual official name for it. But you have to look for it on TradingView. BB Squeeze. It's very simple. You don't have to program it. It just gives you the lines when it's tight enough, according to their rules. All right, next. Oh, thank you, Britt. There's more than one, Iggy. I'm not sure. There we go. All right, so TBAC presentation on digital money. I'm going to open this. So why are you showing me that? To talk about it or to give me some help in fleshing out my own ideas? Andrew, what am I going to
Yeah.
look at? I'm going to open it up.
Yeah, that's all I was doing, just for it's a long presentation, so it's not
Right,
something that's just for background information.
It's a good drill down, is what you're saying. I'd be able to look at this, right?
Yes, it is.
Okay. And is it so? This is U.S. Treasury, and it's not. Is
Yeah.
it biased or unbiased?
It's just informational.
Got it,
You know
got
TBAC, right? It's the Treasury. It's like they do the reports every
Yeah.
quarter and basically say what the Treasury funding requirements are going to be for the following quarter or whatever.
Right.
So they were doing a
It's the
presentation.
Borrowing Advisory Committee. It's
Right.
private sector people advising the Fed.
Right.
Oh, okay.
But
So
Advising the Treasury, sorry.
right. So this would be the private industry being honest and biased, telling them their assessment of the industry of the.
right. The banks don't like it because it takes their business.
Right. Right. Well, yeah. If I'm a small bank and you're a big bank, you like it because you have enough assets to qualify for it. You'll survive because you're systemically important, and I will be screwed. I mean, I'm not saying it bitterly. I'm saying it creates a much more monolithic banking system. If you think about it, it's like the government doesn't control stable coins. The government controls the banks that control the stable coins. So it's the capitalistic version of centralization. It's I guess at its worst, it's fascism, right? And at its best, it's corporatism. Yes, Kevin, Tether's now buying gold royalties, meaning like royalties from mines. All right. Marginal audited last when. Oh yeah, audited meaning Tether, Steve. Yeah, exactly. Tether's never going to be audited. You know when Tether will be audited, Steve? After the bubble inflates and pops. That's when it'll be. That's when it'll be. Thank you, Kevin.
Or it's discovered there's some deficiencies. But you know what? It's not going to be audited because it's not in the United States. It's just that is the weakness of the whole crypto thing to me right now is Tether.
Well, that's right. When you say that's what every problem starts that way. We're not going to audit the asset. We're going to regulate the bank that's buying the asset, and then the bank, right? And then the bank creates all these fucking things. It's like, we bought the asset. We'll put it in the Caymans. We'll put a part of it there, and the government says, "Hey, you look okay. You're fine," and then poof, everything blows up. That's going to happen, but we'll probably have a bubble first. I mean,
I'm sure that you can make a claim on a bubble right now in the crypto. I mean,
no, I think you can. But here's what I'm getting at. Let's say we're in a bubble right now in crypto, right? Let's say we're in a bubble right now for AI. These are all bubbles that could burst, but the stablecoin bubble is just getting blown, right? Right? And so one of these other bubbles could pop, taking stable coins down, and fucking all of a sudden it's like everything is bad, or we'll survive all that shit in stable coins. It really seems like the government is all interested in serial bubbles. Like what's the act? I forget what the act is called, but the act that allows crypto, not the Genius Act. Yeah, the new one that allows crypto to be used for Fannie Mae and Freddie Mac as collateral. I'm like, that's pretty cool. It is pretty cool. But to your point, Steve, how the fuck are they going to know what it's worth? How do they know? Like, how do they know? How do they know you even have it? Here's my Bitcoin. Like, it's going to have to go through. This is how the government centralizes. You want a loan through Freddie Mac and you've got $1 million in crypto? We need to see it. That means it needs to be on an exchange. It needs to be locked. I mean, who the hell knows what's going to happen? But they're just blowing bubbles. Tether is the private version of the global CBDC. That's a good question for everyone. So is Tether the private version, or things like Tether the private versions of CBDC? Does anyone have a strong opinion about that?
I don't think it's developed enough to really tell.
Yeah, that's true. Well, I do know one of the
Vince, I think you're right. What you were saying earlier about it being politically unappetizing to have a central bank issue digital currency. It's a lot easier to have the private industry, private sector stand up a stable coin,
Right.
but with government surveillance tacked onto
Right.
it.
It's kind of like social media, you know, it's a private company and we're going to censor and we're going to tell them to censor for us. Same idea. Yeah, I think if there is a line in the sand, a real line in the sand that we believe government has already gone over, but government doesn't, and that is ultimately they're not tracking our every move. And CBDC gives them that power. Now, seriously, yeah, we're not tracking your every move, but if we want to, we could. We just tell JP Morgan to show us the info. Isn't that what Apple does with the iPhone? Yeah, that makes sense. Thank you. Thank you. Luke Roman. Yeah, Luke's talking about stable coins a lot right now. Yeah, that's right. He's plugged into it. I'm going to open that up later on. When was the last audit of Tether? Steve, no, there was never a fucking audit of Tether. Not a complete audit yet. Yeah, there you go. Changing behavior. So now we're getting back to market. Some amount of news recently. Yeah, right. So here we are. Changing behavior. Some amount of news recently recognized. Yeah. So gold. How about this? At the peak of the war in the Middle East, gold didn't make new all-time highs. At the peak of the
Tariffs.
Liberation War. What's the
Liberation Day.
Liberation Day news? Did gold make a new all-time high? Yeah, it did. It did. And now, so I look at the Middle East war as bullshit for gold. Like, I mean, it's done, right? Even if it does go up again, I'd rather be long oil. I think the upside potential is from Trump, wigging out again, just going, yeah, fuck you, China. Like, I don't know if he's going to do that, but I think we need them as much as they need us, if not more, right now. Virgin Islands, yeah. Tether is headquartered in the Virgin Islands, yeah. Right. All right. Kinesis Money was one of the first digital gold and silver crypto, providing that digital gold. Right. Yeah, exactly. Yeah. Okay, Richard, you don't have to answer this. Kinesis is a solid product, and they're probably going to do well. A bank will probably buy them if their financials are solid. I think they're like Turkey. That might be a problem for some of the American banks. Yeah.
Kinesis, yes, they're largely Indonesia, and Indonesia postal system. All the postal workers get paid by Kinesis.
That's pretty cool. That's pretty cool. And by the way, I forget who said this, but we're talking about the kiosks being everywhere.
Yes.
All right, was that you?
They talk about having the kiosks everywhere they can possibly have, because they have businesses that are tied to Kinesis that have Kinesis business accounts and business loans and payment systems and a credit card. And
yeah, I understand. I'm referring to the concept, not Kinesis. One of you mentioned that they just set up kiosks and people are looking for ways to hedge themselves. Which one of you said that?
Yeah, that was me, Britt.
Yeah, Britt, I want to share this with you because this is a lesson I learned about the exchange business, and this adds validity to what's going on now. So I'm going to paraphrase you. Tell me if I'm getting it right. That you're seeing these things and these products pop up everywhere, and they're below people's radar that are powerful, and nobody cares about them, but they persist, and slowly they're getting traction. Am I saying that accurately?
Yeah, I think okay. I look at this as like it's like an on-ramp, off-ramp without going to the trad finance route.
Right, trad finance, exactly. Okay, so we may look at that and say, okay, that's pretty cool. It's an on-ramp, off-ramp. Now that's the exchange model. Let me explain. Not the exchange model, it's the networking scalability model. Now, here's what I mean. In the US, you own the CME and you have an exchange. The infrastructure is already there. The network is already there. The users are already there. So what do? You say, oh, there's a new product here, and you list it. And nobody trades it, but it doesn't cost you any money. And so it just stays there. It exists under the radar. No one cares about it. When that product takes off, you're involved. So here's what the kiosk is. Very simple, pedantic way to look at it. But the big decentralization in general is the exchange model, meaning I own a business and I want to grow it. It's scalability. I need more money to scale it, and what's what I'm using? I'm committing resources to it, and if it doesn't make me money right away or doesn't show growth or potential, then I'm losing money. In the network model, which is the decentralized models, once the network is established, you don't give a shit about throwing another kiosk out there, about throwing another stablecoin out there. You just list everything. You don't care because there's no marginal cost, and that's what the network model is all about. I understand network model from a Bitcoin point of view, but I mean the network model is once the network is established, and that is the Bitcoin network or a telephone network. How much does it cost to add another phone for me as the phone company when the world already has phones? Well, the network's already there. I don't have to add a line. I don't have to do anything. I just add one wire from the street to the house, and a person's connected to the world, right? And that phone is owned by some guy that you don't care about. But one day he's going to discover something, and that phone will be like you're getting paid for a phone call. You follow me? So the phone company establishes the network, and it's like sunk cost. When you're building a network, it's expensive. It's like, a lot of money up front if you're doing it with an intention. But as it gets built, it becomes self-sustaining. And as it becomes self-sustaining, you just add a product to it. And you don't care about the product until it hits. That's the exchange model. Cable TV is another example. It doesn't always work this way in cable TV, but cable TV, you have the box, you're tied to my network, old cable TV, you're tied to my network, I'm going to throw another channel in there. I don't care, right? And eventually you start to care because it's not purely a network model, but I'm saying that the stable coin phenomena, the decentralization phenomena is based on the networks. And if the network effect, if it gets established, the marginal cost of adding to the network, whether it be another phone, whether it be another listed contract on the COMEX, whether it be a kiosk in fucking bumfuck, Saudi Arabia or, someplace in Zimbabwe, you don't care. The marginal cost is not there, but it's there. It's kind of like marketing by presence. It's there. It's on your screen, and eventually, it could catch fire. And this has triggered me because here's my personal experience from it. I was market making on the COMEX, and I was market making on Clearport and NYMEX, and I had an operation. I had a fund that was running, and Dubai opened its commodity exchange. They announced it, DGCX, Dubai Commodity Gold, DGCX, Dubai Gold Commodity Exchange. And I'm a pure options guy, right? So at this time, right? And I had a friend, Diego, who is like the exchange analyst. He's like the best one, right? And I helped him, he helped me in our fields of expertise. And I learned so much about him, about the exchange model, which is what I just told you, which you may have already known, was revolutionary to me to understand. The thing I took away from that conversation was, the thing that at that conversation was, the network model doesn't cost you anything once it's set up. The network model, if operating scale is the rule that governs expanding a business on the supply side, network effect is the demand side of operating scale. Once you get demand scaled enough, the network can handle anything. You just throw it on there and people pay you for a front page business. Anyway, so the conversation I was having with him was like, at the time, Dubai opened up Dubai opened an exchange, and who else opened an exchange? India, Mumbai. I think it was Mumbai. open exchange, and they were starting with gold. And I'm like, you know, and I rule in gold if I have to. I mean, I get killed as well, but in gold options, there's like, you know, and I ruled in hell, right? I mean, I was as good as every energy options guy out there, but they had too much money. And so anyway, I went to gold and I understood it. And I went to Diego, I was like, Dubai is opening an exchange for gold. Mumbai is opening an exchange for gold. Can you get me an introduction to them? Yeah, I can get you an introduction to them. Great. I want to know if they have a market making program, which is where they sponsor someone to create liquidity on their exchange, because that's what I was good at. He goes, yeah, I can get it for you. He goes, but it's not going to work. And I go, what do you mean? He goes, this is what he said to me. They're just creating the contract to have it. They have something planned in the future, but in the meantime, they just want to get it out there. They just want to create it. I go, well, what does that do? Doesn't that cost them money? He goes, no, it's already, you just list the contract. Nobody cares. And if it grows organically, it grows organically. I go, so what about me? How do I get involved in that? He goes, you don't get involved in it. You wait until they get volumes at a certain level in futures, and then you go to them and you say, hey, I'll do your options market making. And that whole little thing precipitated his education of me. Is like, the network effect is not about creating something to sell it. It's about creating something and waiting for demand to come for it. Anyway, so that's it. I just gave you a long version of that. Anyway, that's why I feel positive on the model of stablecoins before the inevitable bubble comes, because it doesn't cost them anything to list a contract. And that's the thing. This is my problem with Kinesis, not Kinesis per se. Kinesis started with a product in a niche. And I believe Kinesis rules in hell. They probably have one of the better products out there, right? But because there's no protective mode on it, and because they don't have the network already established, it's growing, don't get me wrong. Because they're not JP Morgan, what happens when JP Morgan says, fuck it, let's start a Kinesis type product? Well, that hurts them. JP Morgan's already got the network. They throw the product on the network and they take a lot of the competition out. Now, Kinesis, let's say I'm a bank who's competing with JP Morgan and JP Morgan has their product out. I go, shit, JP Morgan's got a product out. We're behind the curve because let's say Wells Fargo, oh, we're behind the curve because of this, because of that. Shit, we need a product. Let's buy someone. Who's got a good one? Kinesis, buy it. And that's what'll happen, I think, as time goes on. Anyway, all right. Yeah, I don't trust Tether either, Steve. Steve, you know I don't trust Tether, you know. But I front run bubbles too. Kind of the only option for non-US citizens to get exposure, and of course for illicit capital. Right, Tony. Right. Bubbles are a feature, not a bug. Yeah, Leon, that's right. You know, the bubble, like if you think about what they just did with crypto by saying you can use crypto to finance a house, I mean, just simplifying it. What are they doing? They're telling people to buy houses. Like when they say buy crypto, you can use crypto to finance a house. Well, that's bullish for crypto and bullish for houses. How can it be bullish for everything? They're just like creating sponges to keep houses up, to keep values up, to keep stocks up, to keep the debt being ignored. They really have a knack for delaying the inevitable, don't they? Yeah, I mean, Kinesis is good. Let's see. Gold chart. Right? Even audits can't always be relied. Audits are never relied on, Leon. Audits are relied on just so you can get someone to invest in you. We passed the CFTC audit. What about that off balance sheet? Don't worry about that. The audits are as good as the auditor, especially since mark-to-market gap accounting principles. Yeah, that's right. That's right. Here, Britt sends us a link for those trying to get up to speed on Tether. Interview last week with the CEO, very friendly question, but he expands on their business and investments. My question, Leon's question, why are stablecoins needed at all except to facilitate Ponzi finance and out-of-control government spending? Who wants to answer that? I don't have an answer other than the fact that it's hot and people want to make money off of it. I know one thing. Stablecoins allow source and destination to get there without as many fucking middlemen.
I
get
think
rid of
as
5
well as,
middlemen. I'm sorry.
it's a
Go ahead.
way like you can only be long Bitcoin, right?
Right.
Or other cryptos. But this is a way to, if not get short Bitcoin, at least get flat. So if you've got a Bitcoin and you're a speculator, you say, I think it's going to go up, so you make some money, but then you want to lock in your gains. So you move from Bitcoin to Tether, and then it just sits there worth $1. $1 is $1. And then Bitcoin
Right.
goes down 10,000, and then you buy Bitcoin again. So it's a way to step out of your trade without stepping out of the system, without stepping out of the crypto.
Well, let me ask from a devil's advocate point of view. All right.
Yeah.
I have $1 million. I'm genuinely asking because there's a mechanism that I'm missing here. I have Bitcoin, and I take it out of Bitcoin and I put it in Tether, which keeps me in the system. All right. Why? This is what I understand as a person who owns Bitcoin and I have it on a key fob and all that shit. Why does the system fucking matter? Can I just take it off and put it on my, put it on my ledger, my Nano?
Well, you could move it to your Bank of America bank account, but then there's going to be, it's the off ramp, it's the hassle of getting back to your bank account. Whereas this is just parking it in your zero interest bearing account, your dollar holdings.
So
Without,
Tether,
and if you're planning to get back in a week, then you don't want to cash out. You want to leave it in digital form, right?
but I'm getting closer to understanding that. But I just want to take it to the nth degree so I really understand it. But it is a digital form. All I have to do is take it and plug it in and buy it on Coinbase or wherever I buy it. Like,
But
why
you'd be-
do I
you'd be
need
having
why
to-
do I need to have Tether? Was Tether like a money market for me as a user?
Yeah.
Is Tether like a money market for Coinbase? You know what I mean?
Well, it's for they're agnostic. They'll post everywhere, so you could be on a decentralized or a centralized market. You can swap in your ledger. You can swap between Bitcoin and Tether back and forth or something. So they're agnostic that way. But it's just a way for you to lock in. If you're not always a crypto degen and you don't think it's going to go up forever, you can step
Right.
out of it and let the downside play out and then step back in, for instance.
Okay.
If that's
Here's the next question. Okay, now I understand it. Basically, it facilitates your entry and exit on ramp and off ramp without friction and without cost, and it's essentially a cash position for you. All right, so
It costs.
it does.
Fuck yeah, it does. $1,300 to sell a Bitcoin and buy one. It's 1,300 out and 1,300 in.
Those
I
are
mean, it's-
exchange trading fees, though. That's not.
There,
that's
it's still costs. I mean, it
major
doesn't lend
transaction.
itself to trading. And
Right,
and Tether is the central bank of crypto. I mean, that's really what it is.
right.
I think that's the first world use case, but then there's the third world use case, which is I've got a bunch of Zimbabwe currency, and I don't think it's going to be worth as much tomorrow. So I'm going to find a wallet. Some guy is going to give me a wallet to put on my Nokia phone, and I'm going to change from my Zimbabwe to Tether. And I'm never going to touch Bitcoin. I'm just going to park it in Tether because it's.
How do
worth
they
more
get
than-
their Zimbabwe money into the bank at the little kiosk you're talking about? You got to have somewhere to deposit, and it has to be in the regular financial system. I mean, you got to get approved now. It's just, I think you got to use your driver's license to get a Coinbase account. I don't know anything about Kinesis or anything, but it's just you have to have a bank to get in, and then their money sits in their end of it in the pool. And when you cash out, you got to put it back in your bank account. It's a huge pool of fucking money. And yeah, the federal government loves it. They're buying treasuries. That's what they need. They need to sell treasuries, a lot of them too.
So I'm the Zimbabwe guy. All right, I'm the Zimbabwe guy, and let's say I'm not a poor Zimbabwe. I've got $1 million. I've got $1 million in Zimbabwe, whatever they are, and I want to put my money into dollars. Right now, it's in Zimbabwe dollars. I can deposit it into a crypto exchange and buy Tether, and let it sit there, or am I buying Bitcoin through Tether?
It's the same, Vince. The money sits in the Tether account until you buy something. You can buy XRP. It's unlimited.
So when I deposit the money, my Zimbabwe dollars into the exchange, it becomes Tether.
Yes.
And so basically it's immediately converted to whatever the exchange rate was for Zimbabwe dollars to US dollars. Is that what you mean?
Well, it would be U.S. digital coin here, but I don't know what it is in Zimbabwe.
Okay. So
Yeah, it's like a forex transfer, but it's
Right.
it's this synthetic forex, right?
right. So and the bank isn't in the middle of that. Who is in the middle of that? Who is taking that? There's money there.
The exchange.
The exchange is the bank.
Well, it's like, the Coinbases of the world, or every country's got their own homegrown versions of it.
No, right. The exchange is in this example, the exchange is the bank and Tether is the money market. Simple way to look at it. Accurate or no?
Yeah.
No.
If you
Tether's
want to get
the
really
bank.
technical, if you want to get really technical about it,
Yeah.
the
yeah.
exchange is like having a bank account somewhere, and the network where you transact, currently most of the tethers that are in circulation are transacted on the Ethereum network. And so you pay fees to the Ethereum network. In that scenario, the miners on the Ethereum network collect that transaction fee. So you can have an account on an exchange, and then once you move your assets off of the exchange into, let's say, a ledger or a wallet stored on your web browser,
Right. That's what I have.
then
I have a
the
cool
exchange, in that sense is the network, like the Ethereum network. And so the fees that you're paying are going to Ethereum miners to help facilitate your transaction. Does that make sense?
Yeah. The exchange is a broker, and the Ethereum network or miners are running the.
It's like the Swift system. Yes, the Ethereum network is like Swift, and then the exchange is the broker.
Thank you. Who's saying this? Because I have it all hidden on my screen. Who's saying that?
My name is Tony.
Tony, thank you, Tony. Thank you. Right, that help that model. Once I understand the model, then I can apply it in other areas. Does that make sense? Yeah. Okay, that's helpful. I appreciate that. Thanks. Because that's what it's all about. It's all about adoption, economic adoption of a concept or a new product or a new tool is about. There's a guy, Dan Brownstein. He's probably not alive anymore, but he was a bond trader, a mortgage trader, and he was just fucking amazing. And I met him, and I would hang out with him, just to hear him talk stories. I guess kind of like what we're doing a little bit of now. But he would tell me about how he would shop the country looking for mortgages. He was a Ginnie Mae guy and Freddie Mac guy. He'd buy Ginnie Mae's in areas of the country where they were old and people wouldn't refinance. So he ended up getting a higher dividend. It's like the person who doesn't get the best deal. So he would end up buying those. Anyway, he said to me, innovation comes. He was a physics guy. He's like, innovation comes from banks, or that scares banks when there's a pipeline from point A to point B, and banks figure out where the friction is in the pipeline. Let's say it's a seam in the pipe, in the plumbing, and they figure out how to make the seam run smoother. So they get rid of the toll booth, and then they put their own toll booth there. They just charge less. Anyway, so it's kind of like business has friction, and those points of friction are opportunity points for banks to be at, and they occupy. This is the whole, rentier economy, right? They occupy points of friction, and they demand to be paid because without them, it would be worse. And now we're looking at a situation where without them, it would be better. Like it's the next evolution in removing friction. Seamless pipes are invented. And so they have to create the toll booth, the reason for the toll booth. And the reason for the toll booth this time is, and I'm not saying this negative or positive, is regulation. People have to be protected. And so the banks say, you need us there because we'll be your eyes. Anyway, I guess I'm going down a whole bit. It seems like the business model is just replicating itself again. All right. Anything else we want to talk about before we go? 4 o'clock. Well. with that. There you go, Brett. Use case. Sell your goat to a guy who texts you 40 US tether dollars. You never have to set foot in a bank, but you're holding currency and avoiding local devaluation. Right. The plumbing is seamless.
You have to have a bank account to get the initial $40. I mean, you have to
Well-
have an exchange account, and that requires money. And that money
Well,
has to come
Steve-
from a
Steve-
banking system.
That's true, Steve, but like the guy who's buying the goats had to onboard it, but the guy who's selling the goat, he's never even been to a city. Like
He's never gonna be able to get any.
yeah.
He's never gonna be able to use his money because he doesn't have an exchange.
Well, but he's gonna be able to like give someone two USD tether, same method to buy some bread or whatever. So it's once he's in it, he doesn't have to be giving ID and going to the bank.
Right.
He's in it.
So once he gets it, the utility grows. It's kind of like it's in your wallet. You may as well use it. So the banks have to find a new place to open shop, and they'll probably open up a shop in Zimbabwe where the goat guy is. know?
Hey man, that's exactly what's going on right now. Is the banking system's falling apart. You know,
And they
really.
have to go. Yeah.
In a much bigger picture, shotgun style, banking is an antique industry that needing to be way changed.
Right.
And the model is, I think, Bitcoin. I mean, what you guys are saying, I totally agree with. I mean, way I'm devil's advocate, but
Yeah. I totally see it too. I see what you're doing. You're asking the questions that I want answers to. That other
But-
people don't.
But
Andrew
guys,
said,
hi.
Yeah, I'm sorry.
It strikes me that there's a limit to how big these treasury bill-backed stablecoins can be. I mean, if they're going to be used in other countries to transfer tether or whatever it's called between farmers, it's a limit to how big the US debt can be to be used as money in other countries.
yeah, aren't we just, that's a good point. Aren't we just taking money? I mean, I'm not saying anything.
Well, you're disintermediating offshore dollar creation by banks, right? So then it only
Yes.
comes down to
Yeah.
comes down to what the US government's prepared to issue in debt,
Right.
because you're effectively using dollar backed, whatever these things are called.
You're killing the
stablecoins in
euro
other
dollar and
countries.
replacing it with something else.
Well, you're replacing it with with US debt.
Yeah, you are. That's what you're doing. And by the way,
And
there's
limits. There's limits to that, right? I mean, it's
are there limits
it's
to
even
it?
worse than the Triffin dilemma. I mean, it's
Right. Well, no, but I mean, I know what you're saying. I agree with you, Scott. But I'm talking about if you before Keynes, there was a model. I'm saying something that we all know, but maybe not the terminology. There was a way of there was a theory of money called they called it the chartalist money theory, and all it really is that as long as there's debt, there's money. Okay.
Yeah.
So
Correct.
right, and this came right. As long as there's debt, there's money, and it's the premise that the Bank of England exists. If they ever pay that debt back, there's no money, and
Yes.
so right, and so I'm asking you,
there's
Scott,
no state money.
there's no what?
There's no state money.
There's no state money. Exactly. And that's another conversation. I totally agree with you on that. If there's no debt, there is no state money, which is so my question to you is not rhetorical, is when you say there's a limit to the debt, are you saying it from what point of view are you saying there's a limit?
From the
because-
perspective of a US citizen's preparedness for their public
Right.
debt to be used as money all over the world
Right.
by other people who never,
Right.
there's a limit.
Right. No, I thought you meant like strong economics. You're just basically saying that I'm not so sure that I'm going to be happy with us
No,
incurring.
If you've
$1
got
trillion
Indian
in-
farmers trading in frictionless dollars,
Yeah.
which are backed one for one by US Treasury collateral,
right.
there needs to be some sort of massive debt issuance
and
in the US.
which brings us to we're not going to talk about it. Which brings us to MMT. Who cares?
Well, precisely.
and that's
Precisely.
exactly what the digital thing's about. Is you look
Precisely.
at the charts about dollar's lost 99% of its purchasing value. We're still
Yeah.
using it, and now they're
Right.
talking about floating this digital currency. Okay,
Yeah.
they can inflate indefinitely,
Yeah.
indefinitely, and
I-
that's bad for
Or-
gold.
Or you control inflation by taxing U.S. citizens for the privilege of them
Right.
giving their money to other people. That
There
doesn't
you
suit
go,
a
there you
U.S.
go.
citizen, does it?
That's what we're doing right now.
That's the MMT route. The MMT route says the amount of money doesn't matter, which means the amount of debt doesn't matter. We can always raise taxes to slow down an inflationary situation. So can
Correct.
you imagine that? I'm JP
Correct.
Morgan, right? I'm the fucking predatory version of JP Morgan. I'm sitting here, I'm going,
JP Morgan, in this case, doesn't exist. It's Vince Lancy being taxed more so an Indian farmer can buy a goat or whatever.
no,
it is
no,
the
we're not there. We're
example
not, but I need to have JP Morgan there because they're the ones who love this idea. I'm JP Morgan, right? And I go, wait a minute. You mean I can have a new product that allows me to loan money to other countries, to the fucking Zimbabwe tea farmer, and we'll back it with US debt? I'm so pro MMT now. And so they're going to get fee, right? They're going to get, oh my God. So now, meanwhile, I'm the JP Morgan guy talking to the US citizen, and the US citizen goes, he goes, wait a minute. Whose debt is that? And the JP Morgan goes, well, it's America's debt. We're financing the world. We're helping the world to a higher level. And the US citizen says, where's my return on the debt? Oh, well, you've got more choices of toothpaste or something. I don't know what but that's it. The bankers will, this is it, Steve. The bankers position themselves in between the next friction. Even if there is no friction, they create.
No, in this example, the bankers have to be nationalized.
Because they do. Well,
because the argument will be the banks have to fund at the same rate as the Treasury, and that they're only involved in state-directed lending. That's the only way this works. Private banks, as we know it, cease to exist.
That's
in
right.
This world, right?
We can't. But that I believe that will never happen. Meaning there won't be an event. I believe, for what it's worth, that in the end there will be one bank like there's one buggy whip, and then that bank will get nationalized. You know what I mean? Right? Like, right? The New York Fed is JP Morgan 30 years from now, or whatever. It's just it. But we're not going to be. We're not communists. We're not socialists. It's like, what are you? Are you fascist or are you socialist? Communist? It's the same thing.
This is highly socialist.
But this whole
yeah, it is.
This whole trend sounds like a really good growth market for Scott Bessent, though. I think, imagine how much more treasuries you can crank out, and it'll be soaked up by this new trend.
And that's what they need to have happen.
But that's great for the Treasury. I mean, if that's the way it gets in, because basically you're presumably issuing debt at zero interest rates because it's a transactional vehicle. That's it.
Right. And so paper money, or digital money, whatever we're calling it. So the dollar purely becomes, in this utopian or dystopian scenario, the dollar purely becomes a unit of account. Because it still becomes
a medium of exchange.
A medium of exchange, right?
Payment.
Well,
means of payment.
Right. So the stores of value will be the land. They will be the gold. In other words, they're like
it's good for gold.
Money for fucking 100 years, and it's like there's three definitions of money. It's going to be like, what is money? Money is debt. That's what's going to come down to. Money is debt, which means it's not a store of value, which means it's a unit of account just because it's on a ledger, which means it's a medium of exchange digitally. Yeah, store of value will be the fucking the stuff that you keep in your china closet. What is the time scale of all this? 3-4 weeks, Iggy? I don't know. No idea.
Going on right now.
I don't know. You know what? I'll tell you.
That's true.
We should. I don't know, Iggy. I the reason, you know what? Speaking as a completely fucking ignoramus on that, how many years? I think you have these leaps and bounds towards it. right? Meaning like you have like here's the question, here's the thing that I would look for, the first thing, right? So it started in 2010, I agree, Steve, right? After the great financial crisis, or the realization that our how's this, Iggy? Big changes like the ones we're fucking around with here are generational. So it takes 1 or 2 generations. Why? Because the old way of thinking, most of us anyway, at least myself, and I know Steve, we're the old ones here. We have to die for people to be accepting of a new way. There's an expression about the Israelites were in a desert. And I remember asking my theology teacher, why the fuck didn't they just go in the promised land? Why did they wait for 40 years? And he's like, well, they had a slave mentality and they didn't want to go in, and they didn't believe it, and they were negative about it, and they had to die, and the next generation goes in. So that's so to answer your question, Iggy, like just try back into it, it's generational. But I will say this, when the next sign for me is that this is happening is if all this stuff we're talking about is happening and you start to see American banks vertically integrate even more, like you see regional banks disappear, then I'll be like, whoa, we're getting close. Anyway, useless. Digitized cash back in the 80s. Yeah, that's right. They always try that shit. We need to unite everyone. Let's have one language. Let's have one money. Anyway. All right, so that's it. Hi, Irina. I just wanted to say hi to you. I know you're there. No, the Brit, I'm not going to back off on that. They died. You follow me? 40 years is 2 generations. They fucking died. And the other kids were like, oh, okay. I guess I'll use digital money. What's this cash thing? Right? A generation from now, TV won't be a problem. They were not allowed to enter, or they just died?
Well, I think it was by design. They just weren't allowed to make it. Even
I thought you were like quoting me some serious theology there, and I was like, oh shit, I'm over my head now.
Right. I mean, even the last one, like Moses dies just before he can see the promised land. He can't get there. Right. So it's like saying,
that's right.
That's right. Got to clean house.
Moses shouldn't have broken the tablets. That was his problem. He lost his temper.
He lost his cool. That's right.
Yeah,
right.
He's supposed to speak to the rock, and he hit it with his staff instead.
Vince, I have a question that's kind of abstracts from this. I kind of asked it way up above, but I asked it on in your this past week.
Right.
It has to do with the CME depository statistics. So I'm posting a link. I looked at 2 days. I don't understand how they make adjustments to their inventory holdings from a day-to-day basis. And
Hold on, I'm going to pause you 1 second. Is that what this link is? Should I open this link?
Yes.
I'm going to open the link.
That's one day. I forget which day I just posted. I posted 2 days. That's the second day, I think.
Okay, hold on. Make it bigger.
That's the other one. Okay. The other one is the day before. So this is basically a Friday and a Monday. I think this is okay. So here. So I'm saying, okay, well, JP Morgan goes, I don't understand how they categorize, because if you look at the top columns, you're either adding, subtracting, or making an adjustment. So here they're making an adjustment, and they're moving from taking out a registered, going to eligible. So in my mind, that's like, okay, someone's essentially wanting delivery.
Okay.
I don't know. I'm asking that.
All right. Well, let me see. This is silver. This is right now.
Big numbers. That's 7 million ounces in the day.
Yeah. Okay. I get asked this question a lot, or always a version of this question, the registered eligible thing. And let me just recalibrate, because now we're in a different topic.
because I'm trying to understand, like, why is JPM, it's written as this, yet, look up above HSBC, that's only 300,000. So that, that's a chump change compared to what JP
Okay,
Morgan is
right.
doing.
So it sounds like your question involves, I'm not sure what level you're asking for an explanation
Where's
on.
it all going? Like,
Okay, good. All right. So let me, I understand. All right. So I'll start off and then you can guide me. Okay. First of all, registered and eligible. And I will give you real examples because I had this explained to me too, like physically explained to me. All right. So eligible is metal that's in. I'm going to say it even if you know it already.
I understand that eligible means it's already, and it's almost, it's like it's set for somebody to take delivery of it. Registered is it meets the standard, but it's not put in a category where it's not accounted for delivery.
Okay. Eligible. Jesus, I hate when people do this to me. I've answered this so many times, and I'm not saying this in an annoyed way. I'm saying I get it so fucking backwards as well. Eligible means it's not available. Registered means it's available. All right. Let me open up. Let's do this.
Yeah, I've gone through this 16. I do it every other week.
Right. Okay. So see what it says here? Registered metal is metal that's spoken for. It is available for delivery. Eligible metal is not spoken for. So your definitions are right. You had the words backwards.
Okay.
Right? I just want to make sure because I'm going to use the words. Okay. All right. So the way I keep it straight, which is not easy to do, is I go, all right, eligible means it's not eligible, and registered means it's spoken for. Right? I mean, it is eligible. So just for everyone here, just very simply, there's a vault, and in the vault is 7.395 million ounces. And that metal is eligible, which means it fits to your definition. It fits the definition, it fits the qualifications, and if somebody wanted to make it registered for delivery, we would approve it right away. There's no problem. All right. Now, what we're looking at here is on one particular day, JP Morgan has 7.395 million ounces that were sitting in the warehouse that were eligible for delivery, but no one wants it. No one's issued a warrant for it. And it's sitting there. And then all of a sudden, the next day, somebody says they want it. And JP Morgan says, okay, we'll accept your warrant or your whatever it's called, and we'll give you that metal. So does that make sense to you so far? I don't mean to be pedantic. I just want to make sure that we're on the same page.
Yes.
Okay. So from there, now that we're on that same page, forget HSBC. What is your question about what just happened, if anything?
So basically, why would they even have it there?
Oh, why would they even have it there?
Because both classifications meet CME standards for meeting delivery, correct? An ounce of eligible and an ounce of registered are the same.
Hold on, I interrupt you. Start again. The classification comment.
Yeah, an ounce of eligible and an ounce of registered from a CME definition of what the standard is are the same.
Yes.
All of those ounces are all in the same vault.
Yes, theoretically, but yes.
So I'm not quite certain why they're, why the variance and,
Okay,
why,
okay.
why you have
They're
those.
segregated, right, in the same vault.
Yeah,
One
hold on.
can
Let
be
me
delivered, and one can't be delivered.
hold on.
Belongs to somebody else.
Right, exactly. So I think I understand what, Steve, you're right, but I think I know what he's getting at. Are you asking, generally speaking, if it's the same, then why even have it sitting ineligible? Why not have it not in there at all until you need to sell it?
Right.
Okay, all right. There's a couple reasons. I mean, I'm getting that right? You're saying why even have it there at all until you need to sell it? Is that what you're
Right.
saying? Okay, all right. That's good because I can give you a physical story about it. But I'll give you the facts first. All right. I want you to think of the Comex as a way station, as not a warehouse, but an approval of grade. So I have 7.395 million ounces of silver. I do personally, right? I don't, but obviously, right? So I have 7.395 ounces of silver. And I want to, it's kind of like Tether. Sorry to bring that back up, but I want to be able to use it. I want to be able to sell it physically at any time. So I go to Comex and I say, I want to use Comex contracts to hedge it. And so I go to Comex and I say, I have this silver and I'd like to sell it. It's not registered. It's not eligible. It's me. And they go, you have to run it through our system. It has to be tested. It has to be measured. It has to be weighed before it gets through the door, right? Am I pursuing your answer a little bit? I want to make sure we're on the right path.
Yeah, yes, you are.
So it's a weigh station, right? So I take my silver to Comex and I say, here it is. They go, let's test it. This is it's the Bureau of Standards, is what it is. They make sure that it fit. And I'll give you real examples of this afterwards because I was involved in it. I mean, as a retail person, like doing what you're thinking about. So once they test it and agree to it, it's in there. And now the Bank of Vince Lanci has 7.395 ounces of eligible silver. Means it's eligible for delivery because it has passed their standards. It's the physical aspect that divides eligible from non-eligible. It needs to be there. The Comex is an intermediary, right? They want to make sure they don't get sued. So when the contract is, so I'm short a contract. First notice date comes, right? And first notice date comes and there's only two people in the contract, right? There's me, I'm short, and there's you're long, right? We're the only two people in the market. And you say first notice date comes and the long must declare. And the long says, I want the contract. You say, I want the contract. You tell your broker, your prime broker, your clearinghouse, you say, I'm literally taking delivery of it. Here's the money. It's no longer a margin long. I come up with the full face value of the metal for the contract. And let's say it's, 5,000 ounces, right? So I put up the money you put up the money for 5,000 ounces and it's there. Now, the clearinghouse, your clearinghouse reports to the exchange, we have someone who's standing for delivery and wants it. So now you're officially approved as a buyer because your money's there. So now we have from first notice day to expiration day, you have whatever, like 30 days. Let's say we're right before that. And what happens is that contract's open interest starts shrinking. People start pairing off, right? Another long says, I don't want delivery. I'll get out. And so the next day he gets out, or he rolls it, or he sells it, whatever. He does something, right? So what happens is the 10,000 longs and 10,000 shorts become one long and one short. And now it's the last day. It's expiration day. And so they've done this beforehand, but let's pretend they're waiting to the last minute. And now there's your contract and my contract. And the volume on the day is zero because you want to take delivery and I want to make delivery. Okay? So the exchange says, Vince, let's say on first notice day, you say, I want to make the, this is how the exchange works. I was involved in this. Like I was in one of these situations. You declare you want delivery. The exchange gets that notice and then goes around to the shorts until it finds a short that wants to make delivery. Presumably, most of the shorts do. But in this case, let's pretend I'm the last guy. And they find me and they go, Vince, Andrew, at this point, we know each other. Andrew wants to take delivery of a long contract. You're short. I can go to someone else, but do you want to make delivery? Yes, I say, I'll make delivery. So at that point, my eligible becomes registered because it's spoken for and there's a warrant attached to it. And what that does is the pre-measuring and making it eligible makes the expiration go smoothly. We know the metal's good. It's already here. Hit a switch. It goes from eligible to registered and boom, it's out the door. That's part of the explanation. Does that help a little bit?
Yeah, now it's gelling because I was trying to figure out why it's showing up.
Right.
It's drawn, but when you did
Right.
CME
So-
or COMEX is acting like a weights and measures, that kind of made a click for me because now I understand how it's almost got to
it's-
come in through a control.
Right, so it
location
has to be up
and
to
then,
standard.
yeah,
So
I get it.
using
So
that
that would
explanation.
explain the HSBC. What's that?
Right, exactly. So let's look at this right here. Okay. JP Morgan had 7.395 million ounces that were there and up to COMEX standards, but not truly actually not eligible for someone to want. So they're eligible by COMEX standards. They may not want to make delivery of that silver, but it's eligible by COMEX standards. So now let's do the example again. You say I want delivery. I'm the Bank of Vince. There's two longs out there, right? There's you and another guy, and there's two shorts out there, me and JP Morgan, right? It's kind of like a random roulette. So you declare, it's only one, there's one contract, one contract. So you declare and you say, I want delivery, and it goes to the exchange, and the exchange says, I'll match you up. And it's like a trade. They go to me and they go say, Vince, you're short one contract. Somebody wants delivery. Will you make delivery? And I say, no. Then he has to find someone else. And he finds JP Morgan and they say yes. Okay. Now, the moment I say no, I refuse delivery, you refuse to make my eligible metal registered, I have said to the exchange that I don't want to make delivery. I can make delivery, but I don't want to. The exchange will then say to me, well, if you don't want to make delivery now, then you've got 20 minutes. So what happens is the exchange, the guy in the middle, Joe Rye is the guy I dealt with, he goes around trying to find someone who wants to sell. Now, by the way, I can say I don't want to sell because I think it's going higher. I have 30 days to sell or take my short and cover it. So during those 30 days, I'm looking at the market. It's going up. I'll make delivery. I'll wait a little bit. But JP Morgan said, so the exchange is always trying to find someone to satisfy the buyer, right? So they're done. Now, in this case, now we go back to JP Morgan. JP Morgan's at 7.395 million ounces. They're huge. They're not the Bank of Vince, right? And my point is, because they're not the Bank of Vince, they know who the buyer is before they sell it. It's prearranged trading. So JP Morgan is very in tune to who's long and who's short. And they go, all right, I'm getting indications from my client who's long or from another client who's long through the system, because it's an old boys network. Hey, I'm probably going to stand for delivery. Do you have it? Yeah, we have it. It says we have it. But the point is the bank's job, JP Morgan's job, is to make sure that, let's say they have 50 million ounces, and the open interest is for 100 million ounces. Suppose someone stands for 100 million ounces. That's a short squeeze. So the bank is always looking at the amount of open interest compared to the amount of metal available or eligible. And so the bank, in this case, JP Morgan, honors it. They're like the market maker. The exchange goes, JP Morgan, I need a contract. Fine, take it. I don't care. One contract. JP Morgan, I need 3,000 contracts. What? the exchange, once the exchange sniffs that someone wants to take delivery, they go to the big boys and say, do you have this? Do you have this? And that's how they keep it smooth. Now, HSBC, let's go to HSBC to give you an example. HSBC just deposited 301.8 thousand ounces, or 302,000 ounces, right? Now, is that their metal? It could be. They have a miner as a client. The mining is done. They get the metal. JP Morgan says, all right, I'm not JP Morgan. HSBC says, all right, your metal's done. You're our client. Do you want to hedge that metal? Or do you want to sell it directly to the customer? Said the miner says, well, I don't have any customer to buy it this week. I'd like to hedge it. Well, HSBC says, we'll take your metal, we'll put in the COMEX, and we'll sell futures for you. And now it's eligible with futures, but no one's claiming it. And then when that future goes to expiration, and you say, I want 302,000 ounces of silver, HSBC goes to their client, hey, do you want to make delivery or not? I do. Done. They say to the exchange. I don't. Now, HSBC says to the client, if you don't want to make delivery yet, then you have 30 days to roll. Now, if I trust the client, I'll give them full 30 days. If I don't, I'll say, you know what? If you don't want to make delivery, you better fucking roll this. Because if you don't roll it, I'll roll it for you. I will liquidate your position. I'll cover your short. Okay? So because HSBC is big and they're a big player and they haven't been active recently and they're putting metal on the exchange, HSBC, like JP Morgan, is a player with access to physical supply and demand. So you should assume that this metal is being put on by someone who has every intention of, on the surface, of selling it or at least hedging it. The other type of person who puts the metal on the exchange is the person who's a rich guy with 302,000 ounces. And he goes, I want to hedge it. I never want to sell it. I just want to hedge it. Ounces go on the exchange. He hedges it, and the bank manages his risk. Okay, it's first notice day. What do you want to do? Okay, close that short. Oh, you roll your short. You roll your hedge. So that's it. He's creating a dividend for himself. Now, I'll tell you a personal story that's kind of funny. That's how I learned all this. But I want to make sure that everybody understands what I just said. Are you at least satisfied, Andrew?
Yeah, very much.
Okay, cool. So I'm going to end on a funny story. All right. I traded. I told you some of you guys this before, but I got my start in precious metals. But in my heyday, I made most of my money in energy, and I was trading a very, very big portfolio in natural gas. And I was basically a two-man operation trading 20% of the open interest in options in natural gas. And I had this great system. I had this great setup. I had this great software, 12 screens. I had the whole stuff. I have pictures of it somewhere. But the options expire the day before the futures do, right? So if you're long it in the money call, it becomes a future, and the next day you have to get out. Everybody with me on that? Options expire, then futures. Well, in my calculus, in my work, I miscounted by one contract. And that one contract was because I had a break. A break is where I don't know buying one, but the other guy knows me buying one. And so we discuss it, debate it, and one of us takes the loss. Well, in this case, I took the trade, but I didn't know about it because it was like very automated. So options expire, and I get my report. It says, Vince, you're long 30 natural gas, which is not a big deal. And I go, great. I sell 30 futures. So I'm flat. But really, there was one more that I was long that I didn't know about. So I'm mixed. It's actually happened in oil, but I'm using natural gas. So the next day, my clearinghouse calls me and says, and they know that I'm not a physical guy. They know that I'm purely financial in this operation. They go, Vince, you have to take delivery of a contract of natural gas. What are you doing? Are you doing the physical side now? And I'm like, no, why don't you fucking guys tell me? Because we only had one day. And you always do this shit right. So they assume that I would get it right. Now, I'm I'm a big swinging dick as far as options traders go, but I know that the big boys play physical. And I go, so I'm long one contract of actually it was oil, but so I'm long one contract of natural gas. He goes, yeah. I go, now I'm fucking stuttering. Well, what do I do? Like I go from being Superman to being like a blithering baby. What do I do? I don't want the natural gas. I don't know what to do with it. You know, like it was oil. So I just say, I don't want the oil. I'm not going to put it in my bathtub or anything. I don't know anyone. I go, do I have to call up a producer? Do I have to sell it back to them? How much money am I going to lose? Like I'm thinking I'm going to lose hundreds of thousands of dollars because of this one contract. I'm thinking the whole world's out to get me, right? He goes, no, go to the exchange. I go, what's the exchange going to do? And this whole thing I described to you opened up for me. I go to the exchange, and the guy's name is Joe Raya, R-A-I-A. Wonderful guy, in charge of this very thing. He's sitting at his desk, sweet as can be, pleasant guy. Doesn't make me, I'm a blithering nervous wreck. And I go, Joe, I know him because he does other things too. I go, Joe, I'm long one crude oil, and I have to take delivery, but I don't have the money to take delivery, and I don't have the place to put it. I go, what do I do? Like at this point, I think I'm begging for my life. What do I do? I don't know what to do. So the expiration has come. Okay. The contract is gone. There's no place to trade it. It's gone. It's over. Like they're calling me up going, where do you want the oil delivered? And so I'm in front of Joe, like, Joe, what do I do? If there's no contract, what do I do? He goes like this. He goes, no problem, kid. He was totally, he goes, let me call someone. And he calls up the JP Morgans of oil. He's got everyone on his list, right? So he calls up someone he likes the most. And it's probably like, I think it was BP who took my trade. And he goes to BP. The contract's gone now, mind you. He goes to BP. He goes, hey, I got a kid here with a one lot. Would you take it for me? He goes, sure. And now I'm like, what price? What price? Am I getting killed? He goes, oh, you'll take it at settlement? Okay, no problem. And it's over. And I go, what just happened? He goes, oh, that one that's in your column, I'll just erase it and put it in BP's column tomorrow. It's over. As long as the oil is not on your doorstep being delivered, I can always move shit around. And they move shit around, Andrew. That's what they do. So this is HSBC putting metal in, and that's why remember that, what's his name? Michael was his name, I think, Ditch the Deep State. That's his Twitter handle. He spends all this time going through, and he's right. He does his forensic work going, this doesn't make sense. That doesn't, and I go, this is what's happening. They're doing deals after the expiration, and then you see it come up the next day. And that's it. That's how I know. That's how I know what they're doing. And I have other experiences for it too, but that one was kind of the funniest because I was just reduced to a blubbering, fucking idiot. All right. So that's my story. I don't know how to end it after this, but that's it.
That's funny. I figured you're probably out. The average swimming pool's around 10,000 gallons, so you'd probably need 4 or 5 swimming pools.
Well, when it happened to me in oil, that's what happened. Then it happened to me in natural gas. But it happened to me in natural gas when the futures expired on a Friday. So I got my report on a Saturday, and my clearinghouse said, Vince, you're long 3 natural gas. Now I'm like, Joe Raya, I'm going to call my Joe Raya person, but the exchange is closed. And so I called up my broker. I hate brokers. I hate salesmen, but this guy he had the network. I go, Kevin, I'm long 3 natural gas. The market doesn't open until Monday. I don't know what the fuck's going to go on. I can't see Joe Raya to get this fixed until Monday. And he says to me, no problem, you'll curb trade it. I go, what the fuck does that mean? He goes, oh, we trade natural gas on Saturdays and Sundays. I go, how? He goes, we have an hour trading. They have an hour where they get together and square up if they want to do something. They trade OTC privately, and then they enter it into their books on Monday. Gentleman's agreement. So I'm on the phone with him going, where's natural gas going to open up on Monday? Can you find out for me? He's like, what do you got? I go, I'm long 3 natural gas. He goes, I'll take care of it. Hold on. He goes, all right, you're out. I go, who's my counterparty? Because we were going to submit it on Monday in the OTC market. Who's my counterparty? And he said, he said, well, I know his counterparty was. His counterparty was his biggest client. His biggest client was BMO. He goes, BMO took 3 for you. And I'm like, really? Why? I'm their, like, I was their competitor. I'm a little guy, but I'm their competitor. He goes, because BMO is my client. And BMO does what I want him to do, because even though he's my client, he makes his money because I show him trades. And I went, thank you. And that was it, was over. Of course, I owed the broker my life after that. And it cost me fucking a lot of money, but I got out of the problem. That's it. A lot of new messages. There's a lot going on here. I want to save this, but I'm gonna call it a day. 4:43. I'm gonna call it a day. All right. I'm sorry if I didn't get to all the questions or comments, but we can do it again next week.
Vince,
And by the way, you guys are
Betting, we're
You're
betting on you, private market. You lost.
I totally love it. Exactly. Over the counter, Vince. I have you ending at 4:15. It's 4:45, and then there's a knock on my door. There's an emergency. Randy says you have to come fix the tire on his car downstairs. I'm like, okay, fine. I get it.
hey, Vince, what about I mentioned about last month about maybe getting together, have like a anniversary get together for Goldfix.
Yeah, I like the idea, and to be frank with you, I think it's a great idea, and there's no but. I just don't know when to do it. I'm trying to get
Well,
caught up.
it would be like the first time we had a meeting. If you could figure that out, it'd be.
First
There's
recorded.
like 5 of us, right? I mean, well, there wasn't very many people when we started doing this.
No, there weren't many people, but you guys were like, great. It was great. It was great to do it all. I want to do it, and Chris Marcus at Arcadia.
Yeah, I like him.
He's going to have something in Florida for Silverfest. He's going to have like one of his Silverfest things, and those are fun. But it's going to be an event to go to. It won't just be like a virtual thing. And so he wants me to kind of help him with that, in a sense where I'm just going to provide some content. So maybe I can find out when he's going to do it, and then maybe we could do it then. Meaning we'll go down 2 days earlier or something like that if you want to do it.
Yeah,
gotta
like
be-
Saturday night get together for meet
Yeah.
and greet. It'd be fun.
Right? We'll do it be like a pre-party or the rehearsal dinner, right?
The real fun.
Rehearsal dinner. Oh, there's a couple things I wanted to thank you for mentioning it, and we'll do it again. There's a couple things I neglected to mention, but I wanted to mention. Number one, I should be hearing back by tonight from Michael Oliver. Oh, wait, hold on. Hold on.